By the end of this video, you'll learn everything that you need to know on how to get started day trading in 2025. This full course will teach you 10 of the most important concepts that you need to grasp all into one video. I'm going to show you my bread and butter break and retest trading strategy, a simple and repeatable scalping strategy that you can use every day in the markets, how I find my key levels and zones, how I use candlesticks and my favorite candlestick patterns, how to have a top-down approach in the markets. Next, we're going to learn about how to identify liquidity and how we can use it to our advantage, understanding market structure and trends in the markets, how to grow a small account as a beginner, how to create a profitable trading playbook, and finally, 5 steps to become profitable. So with that being said, if you want to level up in 2025, make sure to watch this video all the way through and let's get started. So in today's video, I'm going to break down everything you need to know about the break and retest. And it starts off with identifying these 3 break and retest patterns on the higher time frames. So essentially, I look for these 3 break and retest patterns every single day on the higher time frame. The first one being is the classic continuation break and retest. So what essentially we have is price forms a low, then what we have is a higher low, and then we have a break above our key resistance level. Price then comes back, retest this key level, and we can look for long positions back towards the upside. So this is essentially your classic break and retest where previous resistance turns into support. So what this is a continuation of the trend. Next, what we have is number 2, which is a consolidation break and retest. So what we have is basically price forms a range, right? It's consolidating in the market. It's creating highs, it's creating lows. And what we have is price is inside of a range. What the consolidation break and retest looks like is when price breaks above a key resistance level, being a consolidation high, we come back and we end up using this level as a retest for a push towards the upside. So both of these break and retests are classified as higher time frame patterns, and I look for either the continuation or a consolidation on a daily basis. And number 3 is the flat top break and retest. This is one of my favorite break and retests. What occurs is that we have a flat top. So we have multiple touches right here. As you can see, we're forming what's called a flat top. Price then breaks above our old previous resistance, and then we can essentially use this level as support for that continued push towards the upside. So this is another pattern that I use on a daily basis. So if you see these patterns setting up on the higher time frames, this is a good sign that price is going to have continuation either towards the upside or the downside, depending on what the higher time frames is doing. With this being said, let's go on to some chart examples to really solidify what this looks like. So as you can see right here, what we have is our first example on the chart. We're on the NASDAQ here. You can see that price is right now is currently in a downtrend. So we're making lower highs, lower lows, lower highs. What we really want to see price do is break underneath this key pivot low that it formed right here, retest, and we have that continuation towards the downside. So as we play the tape, what the level we can have marked out is all the way down to here. So now you can see we have that big displacement towards the downside. We broke underneath this key pivot low. So what we would like to see is now this area essentially be used as resistance for that continued push towards the downside since we're in a downtrend. This is the continuation break and retest. So what we can do is mark out this whole area, and now this area be used as a retest towards the downside. A lot of people ask, right, do I draw it a level? Do I draw it an area? I personally like drawing out areas because it gives it a little bit more room, especially on the higher time frames. So once you go into the lower time frames, you can get those nice precise entries. So if we keep playing out the tape here now, you can see that price finally taps back into your key area, which is your previous support, turned into resistance. And now what we can expect is that continued push towards the downside. And as you can see right here, we end up getting that nice leg towards the downside. So this is the continuation break and retest towards the downside on the higher time frames. Now let's go into another example. So now this is going to be a continuation break and retest example towards the upside. As you can see here, we're making higher lows, higher highs, higher lows, right? So we're in a clear uptrend towards the upside. What I'd like to see now to confirm that clear uptrend is a break above this key pivot high. A retest of this key pivot high or a previous resistance turn into support for that continued push back towards the upside. So if we play out the tape here, you can see we finally get that push towards the upside. We have a strong push, right? Displacement. I'll talk about displacement more later in the video, but we have a strong candle closure above this key pivot high. So now this can be used as a valid retest for continuation towards the upside. So you can mark out this whole area as I mentioned earlier, and now we can essentially look for the retest of this level for that continued push back towards the upside. And you can see price finally comes back down in towards our key area, which is our break and retest on the higher time frames. And now what can we expect is that push back towards the upside towards these key highs now on the higher time frames. And you can see right there, price ended up gravitating back towards these equal highs on NQ, which would have made it for a very nice trading opportunity. Also go over my exact entry criteria and how I actually enter in the break and retest later into the video as well. So with this being said, let's go into the next higher time frame pattern that I look for on the break and retest, which is the consolidation break and retest. So as you can see right here, we're on the consolidation break and retest right now. And you can see there's a decent amount of consolidation ranging in between these highs and lows in the markets. As you can see right here, what we have is called a range. So we're in between the swing highs and swing lows of a range. And what we want to see for the consolidation break and retest, either one, a break above the range towards the upside, a retest, and then we have a continuation towards the upside, or we want to wait for a break below the consolidation and then look for the retest towards the downside. So let's play out the tape and see what happens. So you can see right here, we're now closing above the top of the range. So what we're going to be doing and looking for now is the retest of this key area for that continued push back towards the upside. So now you can see we end up using this previous consolidation area, the resistance, end up turning into support as you can see right here. And now what we'll be looking for is that continued push back towards these highs. And as you can see right there, we end up taking out this swing high. That's usually always where your target's going to be. If you're going to be looking to take the break and retest, you're always going to target the first swing high as your first target, and then you're going to be looking for continuation. So now let's go on to another example of the consolidation break and retest. So currently I'm on the ES, and you can see there's consolidation here on this 30-minute chart. We're in between the ranges as you can see right here. And what I like to see for downside is a break underneath this consolidation, retest, and a continuation towards the downside. If I was bullish, I want to see a break above this consolidation high for a move back towards the upside. So let's play out the tape. So you can see right here, price is having a very strong candle closure underneath this consolidation period, confirming that price is now indeed bearish. What I like to see is the retest of this key level for that continued push towards the downside now. So you can see right there, ES, this is our previous support now turned into resistance. You can see there's a lot of selling pressure here at the bottom of the zone, confirming that price should indeed head towards the downside here based off this candle and based off what price is doing. So now let's see if price ends up heading lower. You can see we had another touch of the zone once again, but as long as we hold this key level, as you can see right here, price never had a candle closure back above our key area. And you can see eventually we ended up gravitating down towards the lows, and we had some more continuation towards the downside as well. So now with this being said, let's go on to my third and final break and retest pattern that I look for on the higher time frames. So as you can see, we're on the NASDAQ 1 hour time frame here. And what I'm going to draw out is essentially this flat top or this rising wedge, whatever you like to call it. There's different names for it. So what we have is multiple touches essentially creating this flat top area. And then of course we have our rising wedge. You can see we're creating our higher lows right here. And what we like to see for a bullish case in this example, for that continuation of the trend, it's going to be towards the bull side, a break above this key flat top, a retest of this level for that continued push back towards the upside. So that's what I'd like to see. You can mark out this whole zone and we can drag this over, and we like to see this play out for that push towards the upside. So now we'll play the tape. So as you can see right there, what we're having is they close above our flat top area. This previous resistance now I would like to use as support for that continued push back towards the upside. So now we can look for the retest. As you can see, we get the retest right here. We can look to go long, stop, break below the zone, and look for a 1 to 2. And you can see right there, price ended up tapping nicely once again right into our key area, and we have an explosive move towards the upside on the NQ for a nice push above this swing high and that continued push towards the upside. This ended up being a super nice flat top break and retest, continuation move towards the upside. So now let's look at an example towards the downside. So now this is going to be a bearish example of the rising wedge. This is essentially a falling wedge towards the downside. What we now be looking for is a break below this key level of support. So as you can see right here, we have multiple touches of support. As you can see right here, we're in a clear downtrend. We're making lower highs. What we'd like to see for a continued push, break underneath this key pivot low, right? A retest of this general area for that continued move towards the downside. So we'll wait for a break below this key area. You can see so far we're getting the break underneath this key area. As always, you can mark out this general area. So now what we can look for is the retest off this area for that continued push towards the downside. And you can see price, nice push towards the downside. We're now getting the retest of this area. Your previous support turned into resistance. Now we can expect that continued move lower. And as you can see right there, we ended up taking out this swing low. We also had more continuation towards the downside as well. So this was a great example of the bearish version of the rising wedge or the flat top break. I personally don't like to trade it towards the downside because the markets are designed to go up. So now with that being said, we're actually going to go on to intraday setups. What I just went over are higher time frame patterns. I like to look for these on the 1 hour and daily time frame. But if I'm trading intraday, right, I have different types of break and retest setups as well. So now I'm going to show you guys some of the intraday setups that I look for to be able to capture these higher time frame break and retest moves. So now we're back on the whiteboard here, and what I want to go over is 2 of my favorite setups intraday. Right, so my favorite setup that I look for on a day-to-day basis intraday is your previous day high break and retest. So on the higher time frames, what I'll always look for is if there's any patterns on the higher time frames, and then intraday wise, I want to see where price is at in relation towards your previous day high and your previous day's low. All I'm looking for is price to break underneath your previous day lows for continuation, or if I'm bullish, I look for a break above your previous day highs for continuation towards the upside. So this is one of my favorite things I look for, is the break and retest off your previous day highs and previous day lows. My second entry model that I look for on a daily basis as well, you guys might have heard me talk about this quite a few times, but it's called your opening range break and retest. So right here, this is going to be your first candle of market open. This is at New York session open at 9:30 a.m. Eastern Standard Time. And all I do is look for a break above, a retest, and a continuation towards the upside, or a break below your opening range for a continuation towards the downside. So you can see these are the exact same things, but on different time frames, right? The opening range break and retest and the previous day high and previous day low break and retest are the exact same. We're both looking for the break and retest, but these are on different time frames, and there's actually different criteria. So now let's go into some of the charts and see exactly what this looks like in real time. So right here, what we're going to be looking for is your previous day high and previous day low break and retest, and what we're going to have marked out is your previous day lows. So your previous day lows is your previous session's low, right? Your previous day. So you can mark out the low, as you can see right here. You can also mark out your previous day's high. So what we want to look for when trading this previous day high and previous day low break and retest is a break above, a retest towards the upside, or we want to look for a break below your previous day lows, a retest, and a continuation towards the downside. So we can have these levels marked out, and now we can play out the tape. So you can see right here, price has a fairly strong push towards the downside. Currently, we're underneath your previous day's lows right here now as well. As always, you can mark this out as an area, right? I personally like to draw this out as an area. It gives you better opportunity. There's more confluences, and it allows you to not get faked out on these break and retest levels. So you can see right here, we have displacement towards the downside underneath your previous day's low. So what we're going to be looking for is now the retest of your previous day lows for continuations towards the downside. And you can see right here, price got above your previous day highs, but never broke trend structure. We got back underneath your previous day's low. So now this is where we can go look to short with a stop just a break above, and we can look to target. In this case, right, you can target your swing low. If the risk reward isn't in favor, right, you can target a 1 to 2 towards the downside. So now we can play this out. And you can see price, right, once we got back underneath your previous day lows, we had that nice push towards the downside here on the QQQ. So now let's go on to another example of the previous day high and low break and retest. So as you can see, we're on another example here on the QQQ, and what we're going to mark down as always is your previous day's lows. We're also going to mark out your previous day's highs as well. If we're bullish, what we'd like to see is a break above your previous day highs. Use this as a retest for continuation towards the upside. If we're bearish, we want to see price break underneath your previous day lows for a move towards the downside. So as always, we can mark out this general area, right? We're going to draw out areas of support and resistance, and we're going to drag this over. And now we can play out the tape. So as you can see right here, coming into market open, we're having a big push towards the upside above your previous day's high. So what we'd like to see now is the retest of your previous day highs for that continued push back towards the upside. So if we zoom in a little bit here now, we'll look for that retest. And you can see price, right, we're coming back to retest this level. You can also see that the buyers are now stepping in off your previous day's highs. What we like to see now is that continued push back towards the highs. You can see we get that nice confirmation candle. That's where we can look to get in, risking off the swing low, and we can look to target, as I mentioned, right, either the swing high or a 1 to 2. As I talked about earlier, I'll talk about entries later in a bit as well. And you can see right there, price ended up having a super nice break and retest off your previous day's high for that nice 1 to 2 risk reward ratio back towards the upside. So now let's talk about the opening range break and retest, which is my second entry model that I look for intraday on the lower time frames. So now I want to talk about the opening range break and retest. The opening range has been around for a very long time. I never heard anyone talk about the opening range break and retest. I made a video on it a couple months ago and it did crazy well. And now a lot of people talk about the opening range break and retest. So essentially what it is you want to mark out the first candle of market open. This can be on the 1, the 5, the 15-minute time frame, whatever time frame you're on. You want to mark out the first candle of New York session open. You want to mark out the high and low. All we're doing is looking for the break above, retest, continuation towards upside. If we're bearish, we look for a break underneath your opening candle range low for that continued move towards the downside. So now I can mark out the key levels and play out the tape. So you can see right off the bat, we're breaking above your opening range candle. You can see there's also displacement as well. I'm going to talk about displacement a little bit more, but you can see now what we'll be looking for is the retest off your 493 for that continued push back towards the upside. So you can see price comes back into our level. That's where you can go long. With the stop just to break below, you can target your key pivot high and a 1 to 2. And see right there, price end up having a nice push towards the upside. Essentially what this is another form of a break and retest. This is on the smaller time frames. Whatever direction that price wants to go, generally speaking, right, it's the opening range break. So if price moves higher, right, it's going to have to get above your opening candle print or your opening range. If price wants to head lower, it's going to have to break underneath your opening range and head towards the downside. So that's why this setup works so well, is because of whatever way price breaks right off the bat. Generally the speaking, right, that's usually where the market is going to trend for the day. So now let's go on to another example of the opening range break and retest. So right here, you can see we are back on SPY. We're going to mark out the first candle of market open. We're going to mark out the low and high, what we want to see for continuation towards upside. Break above your opening range candle, move higher. If you want to see downside, break underneath your opening range candle and head towards the downside. So we're going to mark out the opening range high. We're going to mark out the opening range low and play out the tape. You can see price so far, we have that break underneath your opening candle range low. We have some nice displacement towards the downside as well. So now what we'll be looking for is the retest off your opening candle range low for that continued push towards the downside. You can see right there, we're getting that nice reaction off your opening candle range low. That's where we can look to go short, stop just to break above, and we can look to target low of day and a 1 to 2 as well. So you can see right there, price end up taking out the swing low, also your pre-market lows as well for a very nice scalp towards the downside. So I just went over the 3 patterns on the higher time frames. I went over 2 intraday setups as well. I wish I could tell you guys that this is all what you need in order to become profitable, but that's just not true, right? Being able to recognize patterns is one thing, but being able to execute, have an edge, understand your risk management is a whole other scenario. So now I want to talk about rules in the break and retest. So we identified the patterns. Now we need some rules within the break and retest. Your entry criteria, right? Stops, targets, right? Displacement, right? Criteria to identify low, high probability conditions. These are all things I'm about to show you guys next and what you need in order to become a profitable trader. So let's dive right into that. So before we get into my entries and exit criterias, what I want to go over is displacement, right? Displacement is very important when it comes to the break and retest. And essentially what displacement is how violent of a move do we get over our swing high, right? When we're looking for the break and retest, do we have displacement? How strong of a push do we have above this swing high point? Are we displacing above that levels? Are buyers pushing above the level very strongly? And how can we identify displacement? And how can we determine price is going to be a good break and retest or not? So what we want to look for is a strong push towards the upside, right? In this case, price is displacing above this level, right? Usually forms what's called a fair value gap, right? This is the easiest form of displacement. When price has a 3 candle sequence, we have a gap in the markets, then we can look for this level to be used as support for continuation higher. And a second example is when price does not have a strong displacement above a key area. So price usually kind of consolidates above this key area, doesn't show any form of displacement. We don't have a strong push towards the upside. And a lot of times what will happen is this price will end up failing this and it ends up being a reversal. So this is a form of no displacement. When price fails to have strong displacement above our old swing high, this usually indicates that this break and retest won't be as high probability as a break and retest with displacement. Of course, there's external factors, there's higher time frames, there's other confluences that you have to look for as well. But generally speaking, if you're strictly looking at the break and retest perspective, what we want to see is a strong break above our swing high with displacement in forms of a strong buying pressure above that key area. We want to look for the retest for that continuation towards the upside. So this is what we want to look for. So now let's go into the charts and see exactly what this looks like. So we're back on the QQQ chart here. If this chart looks familiar, I talked about this example earlier. This is essentially your opening range break and retest. I have the high of the candle marked out, I have the low of the candle, and what we wanted to look for is displacement. So as we play the tape here, you can see that price has a very strong candle closure above this opening candle range high. So this is what's called displacement, right? You have a strong candle closure above that level. You can see price is displacing above that level. That's why we can look for the retest of your opening range candle high for that continued push towards the upside, because we have displacement and we also form what's called a fair value gap, as you can see right here. So we have displacement, we have a fair value gap. What I'd like to see is this area now be used as support for that continued push towards the upside. And you can see right here, as we played out the example earlier, price taps into our level fairly nicely, and then we end up having that push back towards the upside towards this swing high for a 1 to 2. So this is a good example of what displacement looks like. When we have a strong candle closure above that level, that's when we can look to go in for a break and retest for that continuation towards the upside. Let's go into an example where price does not have displacement. So we're on another example here, and we're going to use the 1 minute opening range break because it's nice and easy. Everyone can mark this out. So now, of course, what we're going to be looking for is a break above, continuation towards the upside, or we're going to be looking for a break underneath your opening candle range low for a move towards the downside. So we play the tape out here. See that price, we have not had a candle closure above that level so far. So now we finally have that candle closure above your opening range high, but you can see this candle, right? Pretty big upper wick. We barely close above high of day, and you can see the next candle, we're already back at this key retest level. So essentially, this is your opening range break and retest, right? What we look for is a break above, retest, and we look for a continuation back towards the upside. But in this case, we don't have a fair value gap. We don't have strong buying pressure above your opening candle range high. We didn't have a strong candle closure as well. So what happens, right? If we take this position long, as you can see right here, and we target high of day in a 1 to 2, what happens? Price ends up getting stopped out. And the reason being is because we didn't have displacement. If we have displacement, that's one of the criteria that we look for a high probability intraday setup for the break and retest. If we don't have displacement, we usually like to stay away because displacement is very important. So now we're going to be going on to entry criteria. This is one of my favorite parts of the break and retest, understanding when to enter, right? The different types of entries on the break and retest and which one fits your personality. So now let's get right into it. So now we're back on the NQ chart. I went over this chart a little bit earlier in my previous examples, and I want to talk about 3 of the different entry models that we can look for. So essentially, there are 3 entry models. We have aggressive, conservative, and then we have our most conservative. So first, I want to talk about the most aggressive entry model being a limit order. The pros about the limit order is that you're going to get in every single time. No matter what break and retest you have, if you have a limit order sitting at your previous high turned into support, you're going to get in every single time. So in this case, how to place the limit order is that as soon as price enters back into your zone, you have already a limit order setting there. Your risk is your swing low, and you're going to look to target basically this swing high, which is a 1 to 2. So as soon as price breaks above the swing high, which is your previous resistance, right, turn into support level, as soon as it taps into your level, you buy and you look for that continued push towards the upside. So this is the most aggressive, right? This comes in form of a limit order, right? In my personal opinion, this one has around a 40% win rate. So it has around a 40% win rate. I personally don't like it as much, but the pros about this is that you're going to get into every single move no matter what. So now I'm going to talk about your second one, which is strong price action. So this essentially means any sort of buying around your break and retest level. This can come in forms of green candles. This can come in form of a hammer candle, right? No matter what, right? It's essentially waiting for the reaction around the break and retest. So in this case, you can see price breaks above, right, comes back and retest. Right off the bat, you have a pretty big push right down in towards your break and retest level. What you can wait for, right, if I kind of zoom in here, you can wait for strong price action. So in this case, you can wait for either your first green candle, right? In this case, you can wait for your first green candle, risking off of the low of the break and retest, targeting back towards the highs, or you can wait for the first sign of buying pressure, which is a hammer stick candle, right? This is one of my favorite entry models, is you wait for that hammer stick candle to form, you get in on that next candle. Risk now is a break below this hammer stick candle. So a good thing about the conservative and the most conservative is that instead of blindly buying right into your key level and risking off this swing low, what we can do is risk off of this new swing low, which is the swing low that should be protected. So in this case, instead of your stop being all the way down here, right, your stop can now be your swing low, which is the new low that it's formed after we put in this hammer stick candle, and we still can look to target the same, which is your swing high or your double top all the way back towards your upside. So this is another way you can enter in the markets, is waiting for strong price action, either being a green candle or a hammer stick candle around your key levels. And then the last one is basically the most conservative, which is waiting for that confirmation. So waiting for that confirmation candle, what it gives you is a higher win rate. So in my back testing, what this gives you is around a 60 to 70% win rate. But what happens is that you have a lower risk to reward ratio. So essentially what waiting for confirmation means is that after you have the reaction around your key level, after you see that buyers are stepping in, you get in once you have a green bullish candle. So in this case, right, we have that buyers that step in off this key level. You wait for that green confirmation candle, and then you get in once that green candle forms. You can risk off of your swing low, and you can look to target the same entry as well, which is your swing high, right? This is the most highest win rate. And in this case, of course, as I talked about, right, you're going to have the highest win rate in this one. The risk to reward in this case is going to be a little bit less because you're waiting for extra confirmation. In this case, you'd be looking for highs, which is not even a 1-to-1. And you'd also be looking for at least a 1-to-2. So you'd be looking for your swing high, and you'd be looking for a 1-to-2 as well. So this entry model, the most conservative, is waiting for confirmation. This is personally one of my favorites, just due to the fact that you do have that higher win rate, but it all depends on what type of trader you are, right? You have to back test this yourself. So there's 3 different entry models here. I can't tell you which one's the best. It all depends on what type of trader and what type of trading personality that you have. I'm going to be showing you my 1-minute scalping strategy that you can use every single day within the first 2 hours of market open. It's super beginner friendly, requires no bias, and all you need is just 1 candle. So with that being said, I'm going to be breaking down the full strategy and do a week of back testing. So let's get into it. So before we get into the back testing portion of this video, I want to explain exactly what this strategy is in 3 simple steps. So you can see the first thing you want to do is mark out your previous day high and your previous day low. So this is on your daily time frame. So the reason why we mark out the daily candles, your previous day highs and lows, is because these areas are used as targets, because there's a lot of liquidity resting above and below those highs and lows. The next thing you want to do is go on to the 1 or 5 minute. This is the first candle at New York session open. So as soon as 9:30 a.m. opens, you want to mark out the first candle high and low. This is what's called the opening range candle. This can be done on the 1 or 5 minute chart. And the next thing you want to do is wait for a break and retest above or below your opening range candle. So either way, for a move towards the upside, what you want to look for is a break above your opening range candle with displacement for a continued push towards the highs. And if you're bearish, you want to wait for a break underneath your opening range candle low for that continuation towards the downside. I'm going to show you exactly what the strategy entails. You guys might have seen my video on the 5-minute break and retest. It's one of my most popular videos, and now we're essentially going to incorporate the 5-minute opening range break and retest in combination with your previous day highs and low candle. So let's see exactly what this looks like on a line chart. So as you can see, we have a line illustration, and what we want to have marked out is your previous day's high and your previous day's low, as you can see right here. So this is essentially step number 1 completed. Step number 2 is mark out the first opening candle at New York session open. This means you can do this on the 1 minute or the 5-minute time frame. So right here you can see I have the first candle marked out on the New York session open, and now what we want to do is wait for a break above your opening range candle for continuations towards your previous day's high. So this is the bullish case scenario of the opening range break and retest, where we're going to look to trade it towards the upside. If we're going to trade this towards the downside, it's the exact same thing but the complete opposite. So we're going to mark out your previous day high, and now we're going to mark out your previous day low candle. So we completed step number 1. Step number 2 is mark out your first candle of New York session open. So we can mark out the opening range candle low and opening range candle high. And now what we want to do, if we're bearish, you want to wait for a break underneath your opening range candle low, a retest of this level for continuations down towards your previous day lows. So that's where your target's going to be. So you can see the strategy is fairly simple. All we're doing is marking out the first candle at New York session open, and we're going to target the previous day's candle high or low. That's all what we're doing. As you can see, it's super easy, it's super mechanical, and now let's hop right into the charts and back test this strategy. So as you can see, we're on my first day here, and we're going to follow these 3 steps. So the first thing we're going to do is mark out your previous day's low, and now we're going to mark out your previous day's high. So we have this marked out. Now we can go on to lower time frames and mark out our opening range candle. So as you can see, we're on the 1-minute time frame here, and what I'm going to have marked out now is your opening range high and your opening range low on the first 1-minute candle. So I'm going to be doing this on the 1-minute time frame. You can do this on the 5-minute, you can do this on the 15-minute, you can go back test this yourself. I personally prefer the 1 and 5-minute candles. So what we're going to be doing is looking for a break below, retest, and continuation towards your previous day lows, or we're going to be waiting for a break above with displacement, continuation for that push back towards the upside. What we want to do is wait for a strong break with displacement above or below your opening range high and low, and look for a retest and continuation towards your previous day high or your previous day low. So now let's play the tape. So right here, you can see that we have displacement towards the downside. What we're going to be doing is looking for the retest of your opening candle print for that continuation down towards your previous day's low. So you can see right here, price is coming back up towards your opening candle range low on the 1-minute time frame. What I like to do is wait for price action for confirmation around the key areas. So right now you can see we don't have a reaction, so I'm not going to look to take a short, right? I have to wait for confirmation around those key levels for me to have a higher probability setup. That's how I personally like to trade. I like to wait for confirmation candles around those key areas. So you can see right here, I have the first 30 minutes played out, and I don't really see a nice entry that I personally would have liked to take. As you can see, we don't really have any real reactions around these key areas. I personally am not going to look to trade. I'm not going to look to force a trade if the setup's not there. You can see we had to push towards the downside. Price didn't want to head lower, so I don't take the trade. And you can see we broke above towards the upside. No real displacement, no real confirmations that price wants to move higher. So for me, this day would have been a no trade day on Tesla. So now you can see we're on the second day here, and as always, we're going to mark out your previous day's high and we're going to mark out your previous day's low. So now after this, we can go on to the next step, which is mark out the first candle of market open. So you can see right here, what we have is the first candle played out, and what we're going to mark out is your opening range high, and we're going to mark out your opening range low candle. Now what we like to do is wait for a break towards the upside for a continuation higher, or we're going to wait for a break below underneath your opening range candle, look for continuation towards the downside. So as you can see right here, if you were to trade this towards the upside, we would be above your previous day highs level. So instead of targeting your previous day highs, what you'd be looking for is a 1 to 2, or you'd be looking for that next key level towards the upside. So now we'll play out the tape. Price, you can see big rejection off of your previous day highs, and now you can see we're well underneath your opening candle range low as well. So if clear displacement towards the downside now, what we'll be looking for is a retest of your opening range candle low for continuations towards the downside. So right here, you can see we're coming back into your opening candle range low. We'll wait for a reaction and to see if price wants to head lower. So right here, you can see we have the reaction around your previous day low level. That's where I'm going to look to go short with the stop, just a break above. And of course, I'm going to be looking to target your previous day low level, which is all the way towards the downside. I can also mark out your low of day, and I can look to take a partial position off at low of day and leave trailers towards your previous day lows. So you can see right there, price is delivering nicely towards the downside, holding your opening range low, as you can see, fairly nicely. Now we just hit low of day, so I can look to take half my position off right there. And you can see right there, I would have ended up taking my final position off at previous day's low. So that ended up being a super solid trade, netting us $376 for the day off of 100 shares. So now let's go on to the next day that we have. So now we're on the next day here, and what we're going to mark out is your previous day highs and lows. Once again, we're going to mark out your previous day low, and we're going to mark out your previous day highs. And now we're going to wait for the first 1 minute candle to form at New York session open. So as always, we're going to mark out your first opening candle, which is your opening candle high and your opening candle low. And of course, what we're going to be doing is waiting for a break underneath your opening candle range low if we're going to look to short for continuation towards the downside, or we're going to wait for a break above your 215, your opening range high, for continuation back up towards your previous high day. So far, we're getting that break above your opening candle range high. You can also see we have a mini form of displacement here, which is an impulsive move towards the upside. So now what we'll be looking for is the reaction around your opening candle range high for that continued move back towards the upside. So you can see right there, we have two candles here showing that buyers are stepping off your 215.40 area. So that's where I'm going to look to get in with a stop just a break below. And as always, right, I'm going to be looking to target, in this case, your previous day's high. So as you can see right here, what we have is a 1 to 7 risk to reward ratio, which is fairly far away. So what I'm going to mark out is partial target. So I'm going to mark out a 1 to 2, and I can mark this out as a potential key area to look to take profits. And then I can extend this all the way back towards the upside. So let's play this out. So right there, you can see I just took off half my position after hitting a 1 to 2. Now I'm going to look for that next level, which is all the way towards your previous day highs. So right there, as you can see, I would end up cutting my position right there for the rest of my trailers in profit as it came back down underneath your 218 level. Still end up being a super solid trade. Didn't quite end up gravitating towards your previous day high level. As you can see, it had plenty of room, so it doesn't need to hit your previous day highs for you to make money. So now let's go on to the next day. So now we're on the 4th trading day of the week. And of course, we're going to mark out your previous day's high, and we're going to mark out your previous day's low. So after marking out your previous day high and previous day low, we're going to mark out your first candle of market open. So you can see we have the first candle played out, and as always, we're going to mark out your opening candle high and your opening candle low. And what we're going to be doing is waiting for a break above your opening candle high for a move towards your previous day high, or a break underneath 218 for that continued push back down towards your previous day's low. Right here, based off the first couple candles, you can see we have a lot of displacement towards the downside. So what we're going to be doing is looking for this area to be used as a retest for continuations back down towards your previous day low. As you can see, sellers are stepping in off of this opening candle range low. After this confirmation candle, you can look to get in with stops just to break above. And as always, you can be looking to target your low of day and your previous day lows as well. So you can see right there, price just ended up hitting low of day fairly quickly. We can look to take half our position off at low of day. And right there, you can see price delivered fairly nicely towards the downside, where I ended up taking off my final position off at previous low of day. So now let's go on to the final day of the week. So as always, what we're going to have marked out is your previous day's high and your previous day's low. And now we can go on to the 1 minute time frame to mark out your opening range candle high and low. So right here, you can see we have our opening range candle. We can mark out our high. We can mark out our opening candle range low. So now what we can be looking for is a break underneath your opening candle range low for a move down towards your previous day low, or we can be looking for a break above your opening range candle for a move back towards the upside. So far, you can see we're having a nice reaction off your opening candle range high. You can see right here, we're having a nice reaction off of our opening range candle high. You can see that the buyers are stepping in off this 214 area. So that's enough for me to get in with a stop just a break below. And I'm looking for continuations back towards your previous day's high. So you can see right there, as soon as I entered, price immediately reversed and I ended up getting stopped out at your opening candle range low for a loss of $285. So that concludes our week of backtesting. Now let's go and see the results that this strategy has produced. So as you can see, I have the trading results pulled up. So on day one, as you can see, we didn't win and we didn't lose. So it was a net break-even day. On day number 2, we ended up making $376. On day number 3, as you can see right here, we ended up making $199.50. Day number 4, we ended up making $247.50. And then in day number 5, we end up losing $285. So as you can see, if we add up the total P&L for the green days, it totals up to $823. And if we add up the total red days, it equates to $285 in the red. If we took every single trade with 100 shares, we would be left with a total P&L of $538 to end off the week. If you can identify the supply and demand flip zones, you'll be able to capture the best trading opportunities. To make consistent profits in the market, you need to be able to identify and trade with the smart money. So in today's video, I'm going to share with you how you can identify these supply and demand flip zones and how you can use them to make money in the markets. Okay, so in today's video, I'm going to be talking about supply and demand flip zones. This is one of the more advanced concepts I'm going to be talking about, but I'm going to be simplifying it today so you guys can use these supply and demand flip zones in your day-to-day trading. So in today's video, we're going to be talking about what are supply and demand flip zones, how to identify and draw them, some things to look out for when identifying and drawing your supply and demand flip zones, as well as, of course, the last part being how to combine them with the break and retest. I trade the supply and demand flip zones a little bit more differently than how most people trade them. I'm going to break down exactly what I'm looking for when trading the supply and demand flip zones. So let's get into it. The first thing that we're going to be talking about for the supply and demand flip zones is that we're going to be looking for key areas on the chart where supply turns into demand and vice versa, right? So supply turns into demand or demand turns into supply. So you can see right here, we have a line illustration on the chart and that we're clearly in a mini uptrend, right? We're consistently making higher highs and higher lows. And you can see in this case, right, we have what's called our demand zone. So you can see price is holding the bottom of the demand zone. And then we end up having our break of structure right here and we have our push towards the upside. So as we see price comes back into this original demand zone, you can see the price ends up breaking structure towards the downside. You can see we come back into now what's called a supply. So we have our original demand on the left hand side and now what we have is our supply zone on the right hand side. So we have that break of structure right here. We come back into this level and now this area should act as supply for a push towards the downside, as you can see right here. So supply and demand is very similar to support and resistance, right? We use these concepts in combination with one another, but supply and demand are areas of support and resistance instead of actual key levels. And that's exactly what we're going to be talking about today. How can we use these supply and demand flip zones in our day-to-day trading? So what do these supply and demand flip zones look like on a chart? So you can see we're on my first example here, and we're going to be talking about supply turning into demand. So you can see right here we have identified our flip zone. So this was our original supply zone, right? I'll talk about how to identify and draw them in a second here. You can see once we get below this, we end up using as a retest towards the downside. We end up coming back into the bottom of the supply zone, rejecting this area, pushing towards the downside. As you can see in this case, once more, tap into this area once more, pushes down, and then we get back inside to the top of our supply zone. You can see we end up rejecting this area and then pushing back towards the downside. You can see we tapped into this area once again, one more, and then another time right here. And you can see right at the end, this is where we finally have that large leg of displacement. We finally have our break above this supply zone, and now this area can be used as a retest, and you can see we have that push back towards the upside. So this is a classic example of what's called your supply turn into demand, or your flip zone. Next on the chart, now we're going to be talking about demand turning into supply. So you can see in this case, right, the way we drew this demand zone was that there are multiple touches. You can see right here, we drew out our large box. You can see this was our area of demand. You can see there's a big touch here. We touch it once more again. We have another touch as well. So multiple touches, the better. You want to look for at least 2 to 3 touches when creating these supply and demand zones. So now you can see we have that break of structure towards the downside. So now what you want to see is this demand zone turn into supply. So you can see price ends up coming back into this area. We end up touching this original demand zone, now turning into supply. You can see we're rejecting this area, and that's why we have that push towards the downside. So in this case, this is a classic example of demand turn into supply. So when looking at these levels are interchangeable, right? Demand turns into supply, supply turns into demand. It's very similar to support and resistance, right? Support turns into resistance, resistance turns into support. But the main thing about demand and supply is that it's a key area on a chart and not just a key level. Next thing we're going to be talking about is how we can use these supply and demand flip zones in combination with my bread and butter strategy, which is the break and retest. So you can see in this case, what we have is our flip zone drawed out. You can see this was our original supply zone. You can see we tap it here, we tap it here, we have that push towards the downside. So you can see right here, we get back into our supply zone. We end up having displacement towards the upside. You can see price ends up returning back into our now supply zone, turn into demand. You can see we tap this level very nicely, and that's why we have that push towards the upside. So if you're looking at it from this perspective, you can clearly see that this flip zone was used as a break and retest. We originally had our break and retest towards the downside right here. Once we got back above that level, you can see this level used as support for a push back towards the upside. You can see once we have this leg towards the upside, we end up using this level as a break and retest back towards the upside. So you can see this supply and demand zone was used as a break and retest towards the downside and towards the upside as well. So this is a classic example of how you can use the break and retest in combination with your supply and demand flip zones. So these are just some of the key things to look out for when identifying your key flip zones. The first thing you want to have is multiple touches. This means you want to at least have 2 to 3 touches on the higher time frames. The time frame to draw these key flip zones are on the 1 hour time frame and above. You also want to look for multiple confluences as well, where you have multiple touches. You also have multiple key levels coinciding with your key flip zones as well. That's when you have the best high probability flip zones. Other things to look out for is strong displacement. Whenever you want to see supply turn into demand or demand turn into supply, what you want is strong displacement. You want to see a strong break above your demand zone or below your demand zone, and then you want to see a retest of that level to confirm that flip to either side. So you want to have strong displacement, and then lastly, what you want to have is a shift in order flow. A shift in order flow essentially means that we have a market structure shift or a potential break of structure where now the order flow changes from bearish to bullish or bullish to bearish, and we start trending in either direction. So these are the main things to look out for when identifying and trading these flip zones. And now I'm going to be going on to some examples that I have for us today. So before I get onto my examples today, I want to talk about how to identify and draw these flip zones. As I talked about, you want to start off on the higher time frames, and you want to have what's called multiple confluences and multiple touches. So you can see this is a great example to start off of on trying to identify your key flip zones. The first thing you want to be doing is going on to the higher time frames. Currently, we're on the weekly time frame on AMD. The main thing you want to do is mark out key levels. So you mark out your key level, which is your all-time highs all the way back from November, and now you want to go on to the lower time frames. So you understand that we have this previous all-time highs level. Now what you want to do is go out and mark out your key flip zones. So we can use this level right here and mark out, there's multiple touches right around this level. You can see we can mark this out right here. As you can see, this is a great example of a potential flip zone. You can see right here, once we break above, we end up using this as a retest. One touch here, two touch, three touch, four touch, right? Price has a big push towards the upside. As you can see right here, we touch it once more. You can see once we got below, we end up using this as supply back towards the downside. Now price is kind of just consolidating in this area, and now we're underneath it and we're trying to use this as supply back towards the downside. So this is a classic example of your previous demand zone now turning into a supply zone. So as you can see, right, we had original demand now turning into supply towards the downside. So with this being said, let's go on to some examples that I have for us today and how we can use this to trade intraday. Okay, so you can see we're on my first example here, and this is on the Apple daily time frame. And the first thing we're going to be marking out is key levels. So you can see right here on the daily time frame, we're going to be marking out this key level because this was our previous resistance area and now turned into support. The other areas we're going to have marked out as well is this key resistance area that it's currently having. Right, you can see it's currently trying to reject off this area. So these are a couple flip zones that we're going to be looking for. Of course, we also have your all-time highs level towards the upside. So now we're going to be going on to the lower time frames. So you can see now we're on the 1 hour time frame and we're going to be marking out our key levels. So you can see right here, this is what's called our flip zone. So you can see right here, this is our supply zone, right? Price tried getting above this area, but we never ended up getting above it in the actual hours, right? This is the pre-market, and you can see we end up failing towards the downside. We start using this area as supply. You can see there's multiple touches here. So what we're going to be looking for is a potential break above this supply zone and then look for this retest for a push towards that all-time highs level on Apple. So we can play the tape here. As you can see right now, currently, you can see this flip zone, right? We use this as resistance, and now we're getting above this area. So we're going to see if this area can be used as support for a push back towards the upside. So now we head on to the lower time frames here. So right here, we're coming into market open here. We're going to be marking out key levels in combination with our flip zone, right? We're going to mark out your previous day high level. So you can see this is your previous day high. It's also in combination with your key flip zone as well. You can see we're now above this key flip zone. So we want to use this level as support for push back towards the upside. So if we go into the 1 minute time frame here, so now coming into market open, we have all our key levels marked off, right? We have our key flip zone on the higher time frame. We also marked out our previous day high. So we want to see the reaction of this level coming into market open. So you can see price opens here and we end up tapping into our key flip zone and our previous day high. And you can see that price is respecting this level. You can see price is respecting our previous day high. It's respecting the top of the flip zone as well. And we're not even having a candle closure inside of our key flip zone. So this signals to me that price is very much bullish, and now we're going to wait for our bullish confirmation. You can see right here, price ends up respecting our level. That's our signal to get in after this bullish candle. And now we're going to be looking to enter in our position with stops just a break below our flip zone, and our targets in this case is going to be on the higher time frames. So you can see their first target is going to be our pre-market high, and our second levels is going to be back over here, which is a key pivot high from a couple days earlier. And now we're going to drag this out, and this is going to be our trade thesis for the day. As we play the tape here, you can see price comes up to our first profit target. We would have scaled a little bit there, but we would have been leaving them for the main target, which is our key level on the higher time frames. As we play the tape here, you can see price ends up tapping into our key order block, and now we're expecting a push towards the upside. As you can see, price ended up tapping into our top of our key level very nicely. We had a very nice reaction off of our flip zone, also coincides with our previous day high as well, for a very nice push towards the upside. So let's go on to the next example that I have for us today. So you can see we're on my next example here, and this is on NVIDIA on the higher time frames. And you can see when we're looking to draw our key flip zones, you want to look for the areas with the most confluences and most touches towards the upside. So this is the area that I have drawn out. You can see we have multiple touches here. This was used as demand. You can see we end up using it as supply right here. We end up getting above it, no real displacement towards the upside. We end up breaking back below, using this as supply for a push towards the downside. You see right here, use this as supply once more. You can see now price is pushing back up to the top of our flip zone. And now what we can do is go on to the lower time frames. So you can see right here on the previous day, we have a very strong push into our flip zone. You can see we end up tapping the top of this flip zone, and in the pre-market, we end up getting above this area. So now we want to use the supply level as demand for a continuation towards the upside. So right now you can see we're on the lower time frames. The areas we're going to have marked out is your pre-market high. We're also going to mark out your top of your flip zone, which also coincides with your previous day high as well. And we're going to see the reaction around the top of your flip zone in combination with your previous day high as well. So as we play the tape here, you can see coming into market open, right, price taps into our key flip zone, right, and it's also tapping into our pre-market high as well. So what we're going to be doing is waiting for a potential break above this level for a push towards the upside. So you can see right here, we end up having our confirmation candle. We end up tapping into the top of the flip zone. You can see we have buyers stepping in. We also tap into our previous day high level, and we have a push towards the upside. And that's where we're going to be looking to take entries after that confirmation candle with stops just to break below your opening candle low. And in this case, we're going to be targeting our higher time frame levels. As you can see in this case, we're going to be looking for this key pivot high, and we're also going to look for this key pivot high as well. And now we're going to go back onto the lower time frames. And you can see this is a 2-to-1 risk to reward ratio trade. And now we're going to wait for price to play out. And you can see right there, price had a very strong push off our flip zone, right? This also coincided with a previous day high retest. This also coincided with an opening drive play straight towards our key profit area, which is our 90.85 level on the higher time frames. And with that being said, let's go into the final example that I have for us today. So you can see we're on my final example, and this is on the Tesla chart. You can see we're on the daily time frame, and the areas we're going to be marking out is key areas with multiple touches. So you can see in this case, this is our first key flip zone that we have. You can see this area was used as support, turned into resistance, got back above it, tried using it as support here, got below it, used it as resistance, and now it's just kind of consolidating around this level and using this as resistance towards the downside. So this is our major key flip zone on the daily chart, and we can draw out another key flip zone. As you can see, the range is getting a little bit tighter here. So we can draw out this key flip zone towards the downside as well. So we have our flip zone towards the top side, which should act as supply, and we have the bottom, which should act as demand towards the downside. And now let's go on to the lower time frames. You can see right here on Tesla, we have a very tight range between demand and supply. You can see we're really bouncing in between these ranges, right? Using this low as demand, using the top as supply, and we're bouncing in between these ranges. So whenever this is the case, what we want to do is look for a potential range break and use these areas as flip zones. So you can see right here as we play the tape out, as you can see, price ends up coming and tapping our low all the way back here. After this breakdown on Tesla, we're going to be looking for two potential trade scenarios. We're going to be looking for this level to be used as potential resistance for a pushback towards the downside, or what we're going to be looking for is a potential reclaim of this level and use this as support for a move back towards this upside. So as I talked about, these levels can be used as support and resistance, or supply and demand, and these levels are interchangeable. So that means you can use them as resistance, you can use them as support. These are key institutional levels where big players are looking to facilitate their orders. So now we're going to play out the tape. So you can see here, price is now coming back into our flip zone, and there's two scenarios that price can do. We can either reject off this area and push towards the downside, or we can reclaim this level and push back towards the upside. Either way, we're going to be looking for a trade opportunity. So let's go on to the lower time frames. So you can see we're on the lower time frames here as market opens, and let's play out the tape. So you can see price is now pushing into our flip zone. So you want to see if price potentially can reject this area, or we're going to break above it, use this as a retest for a move towards the upside. So you can see that price is currently trying to reject the top of this flip zone, but you can see this wasn't really a strong confirmation candle. You want to see if price can either have a next leg towards the downside and break structure, or we're going to have that next leg towards the upside. Now you can see we're above our flip zone. Now what we want to do is use this area as support for a push back towards the upside. So you can see price is now tapping into our order block on the 5-minute, which also coincides with our flip zone on the lower time frames as well. So now we can head on to the 1-minute time frame. So now you can see price is now tapping pre-market high perfectly, which is the bottom of the flip zone as well. So now we'll wait for an extra confirmation candle for moves back towards the upside. So now you can see we have that confirmation candle. We're going to have stop just to break below the flip zone. First target's going to be high of day. And now we're going to go back onto the higher time frames to look for targets. You can see in this case, the next target we can mark out is this key pivot high. We can mark out this key pivot high all the way back towards the upside. You can just mark out key targets. Right, you can mark out key targets. You go back onto the 1-minute time frame. We can just extend it back towards the upside. And this is the trade that we're going to have. So we play the tape here. You can see price tapped into our first profit target. That's where we're going to be looking to scale. You can see we end up using this as a nice break and retest back towards the upside. See price tapped into our second profit target. And our third profit target as well right here. So as you can see, this was my final trade towards the upside. And you can see these flip zones are used very nicely in combination with the break and retest. Being able to read candlesticks and analyze charts is very important when it comes to day trading. So in today's video, I'm going to share with you how you can use candlesticks properly on a day-to-day basis to make money in the markets. So in today's video, we're going to be talking about candlesticks and how we can use them on a day-to-day basis, right? As you can see on the charts, there's thousands of candles that are forming every single minute on every single chart. And how can we use these candlesticks? What are candlesticks? How can we identify bullish versus bearish candlesticks? And how can we use them to make money in the stock market is a great question. So first, what we want to understand is how candlesticks form. So as you can see right here, we have what's called a bearish candlestick, right? So we have our open, which is at the high, right? So we open right here, we have a move up, we go all the way down, right? We have a strong push down towards the downside, and then we end up closing back inside the range to close the candle, right? So this is what's called the body of the candle, right? The open close is the body of the candle. The high of the candle and the low of the candle is what's called the wicks, right? So you can see this is the body, and then you can see right here the upper shadow and lower shadow, it's what's called the wicks. And you can see on our bullish candle, it's the exact same thing, but for the opposite side. So you can see right here, we have our open, we push in a low, we make a new high, and then we end up closing back inside the range, and that's what's formed our bullish candle, right? When we're talking about bullish and bearish, we're talking about green and red. So bullish is usually indicating a green candle, bearish is indicating a red candle. So you can see right here, right, this is the anatomy of how candlesticks form, right? Open, low, high, close is very important if we're trying to make money in the markets. And now we're going to be going into the different types of candlesticks. So when we're talking about bullish candlesticks, right, we're going to first be talking about reversal patterns, right? So whenever we have reversal patterns, what we have is a hammer candle, which is one of my favorite candles that usually indicates a potential reversal in the right context. And an inverted hammer, right, can also be used as a potential reversal pattern. What we also have is a bullish engulfing, right, is where the previous candle, right, engulfs the full candle. If you have a down close candle, right, and we have the next candle, which is green, right, this is a whole engulfing candle which overlaps the previous candle. We have a tweezer bottom, which signifies a potential double bottom and a potential reversal. We have all different types of bullish patterns, but the main things I want you guys to look out for are the hammers, the inverted hammers. These are the most important candles in the right context. And as we go over to the bearish candles, what we have is the hanging man and we have the shooting star, right? These are also very important as well. When we're talking about the bearish candles, it's the opposite of bullish, right? When we're in a downtrend, we want to be looking for these type of pattern continuations, right? We want to be looking for the inverted hammer or the shooting star for a potential move towards the downside. You can see, right, the bearish engulfing, the tweezer top, right? There's a bunch of different types of candlestick patterns that form, but the main things you want to look out for are the context behind the patterns, what's happening on the higher time frames, and then you want to focus on the actual candlestick itself, right? There's a bunch of things that go into the actual candlesticks. As long as you understand the open, high, low, close, right? That's one of the more important things when it comes to understanding candlesticks is the open, high, low, close. What's happening on the higher time frames? Where's the draw and liquidity, right? The actual candlesticks on the lower time frames don't matter as much, but it's a good thing to understand how they form and what it actually means. We also have neutral candlesticks, which is the doji, right? Gravestone doji and dragonflies is when there's, right, the buyers and sellers are even, right? Whenever we have bullish candles, you know that the buyers are in control. We have bearish candles, the bears are in control. But when we have neutral candlesticks, there's no control on the buyers or the sellers, right? Buyers and sellers are in agreement on price. This brings me to key things to know when you're talking about candlesticks pattern. One of the most important things, as I always mention, is the higher time frames, right? The higher time frames always hold more power, right? Imagine you're stuck on the 1 minute time frame, right? 1 minute candle in the grand scheme of things doesn't really make a big difference, right? 60 1-minute candles equals 1 hourly candle. So if you have 60 1-minute candles, right, throughout that whole 60 minutes, right, a singular candle should not have a significant impact on price compared to 1 hourly candle that makes up all the 60, right? So higher time frames always hold more power. So you want to always start off on the higher time frames, and that's why you want to have multi-time frame analysis to see what's happening on those higher time frames. Candlesticks are the most powerful around key levels. As I always mention, right, higher time frame levels, key pivot points on the chart, right? Whenever you're talking about candlesticks, the only candlesticks that really matter are around key pivot points and higher time frame levels, because those are the levels that have the most liquidity, that have the most volume, and everyone's going to be looking around those key levels. So price reaction around those key levels and how those candlesticks form will paint the picture and tell you a lot about what price wants to do. Also, what we want to do is wait for candlesticks to close, right? I can't stress this enough, right? Candlesticks, waiting for candle closures is very important, right? As I always tell you guys, right, the wicks do the damage, the bodies tell the story. So you always want to wait for those candlesticks to close, because they could potentially wick you out and actually go in the direction that you thought it was eventually going to go into, right? So that's why you always want to wait for those body candle closures. So with that being said, now I'm going to be going on to the examples that I have for us today. So as you can see, we're on my first example here on AMD, right? And you can see that we have a very key level, which was this previous all-time high level at 184, and now you can see that price made a push up, and now it's coming all the way back down to come back for a retest. You can see what's happening here, right? So you see we have a nice green candle that came back down into this now resistance turned into support. You can see that candles right here, it wicked below, right? It opened here, came down, made a low, and then end up closing above, right? So signaling that this is now resistance turned into support. So you can see here that the candles were respecting this support level, pushed higher, and now price is coming back down. You can see right here, came back down, retested in the after hours, came back down in the pre-market, and then we end up having a push back up into this level now, which is now going to be using it as resistance, right? Before we had a support level, now we have a break of the support level, and now you can see it's using it as resistance. Now you can see price came down, came back up to retest this level, this 184.92 level again, and you can see that price ends up this bearish candle, right? We open right here, ends up pushing higher, makes a new low, and ends up closing below, signaling that it is bearish. So this is what to look for on the higher time frames. And now let's go on to lower time frames to see how we can use this to make money. So as you can see around the 5-minute time frame, you can see that this is a very key level, right? This 184.92 level, right? You can see that we're using as support earlier, and now we're underneath this level. So what we want to see is now a potential retest of this level for moves back down towards the downside. So you can see on the very first 5-minute candle, you can see that the candlestick is trying to wick above that, right? You can see that it opens all the way down here, right? Makes a new low, is trying to push back up, but you can see the wicks, right? The wicks are trying to get above that level, but you can see the body candle closures are closing below this 192 level. So as long as the bodies are respecting the level, right, you know you're in a very good position. And you can see right here, the next candle, right, price ends up opening right here and ends up closing right at the low. So you can see that the wicks right here, the wicks do the damage, but the bodies tell the story. You can see that the bodies are respecting this level, so you can expect for continuation towards the downside on AMD. So if we're looking at a position towards the downside, you can see that we have a strong push up, but you can see that we never end up closing above that level on the 5-minute chart. Also on the 1-minute chart, you can see that there was not a strong close above that as well. So you can see right here, this was the strong bearish candle that would have gave you the confirmation to enter in a short. So you can see once we have the reject on the 934 candle, the 935 was the confirmation. Once this candle closes, you can take an entry short and you can have your first profit target being at low of day. Obviously, this is only a 1.43 risk reward ratio. So I usually like to aim for at least a 2 to 1. So we can go back onto the higher time frames here. You can see that we want to mark out key levels. So we can mark out this key pivot level right here. We can mark out this key pivot level down here. That's where the liquidity level is, right? So these are the levels that you can use as targets. So now we go back onto the 1 minute time frame. You can see that I now can use this as profit targets, right? You can have your first profit target at low of day, second profit target at this key level at 178, and then your third profit target at 175. So now we can play out the tape. You see first profit target hit, right? Second profit target hit. And you can see right here, we probably would end up getting stopped out because it took too long. But you can see right here, right? This is a perfect example of how we can use candlesticks right at the open, right? With confirmation, with key levels, right? Opening drive play with having a thesis, right? The candlesticks in itself, right? You have to use context behind the candlesticks, right? You can't just see a candlestick pattern and just enter in a position, right? We need context. We need to develop a plan. We need to develop a thesis, and then we need to use those candlesticks as confirmation to actually support a thesis. So now I'm going to be going on to the second example that I have for us today. So right here, we're on my second example right here on NVIDIA, right? As you can see, we're clearly in a bullish structure, right? We're clearly making new higher highs and higher lows. So we are coming up to a key resistance level on the higher time frames. So we want to see what type of reaction we get coming into market open. You can also see right here that we have a gap up during market open, so that's something to keep in mind as well. If you're trying to trade the upside, we do have a gap fill towards the downside. When you're looking at long positions coming into this open, it's really off the table because we are overextended. We're coming up to a key resistance level and there's a gap fill towards the downside. So most likely what we're going to be looking for is potential moves back down towards this 905 level. So now we can go on to the lower time frames here, and you can see that as we play the tape, you can see that right off the gates, right, we end up coming up and sweeping this level. You can see they end up coming up, sweeping this level, and you can see that the bodies, right, you can see the wicks do the damage, right, bodies tell the story. So you can see that it wicks above this level, but the bodies ended up closing below this level. So what this indicates to me is that sellers are stepping in at the highs, right, and now they're trying to push price back down towards the downside. You can see right here, right, price ends up pushing. You can see right here with the wicks, and you can see the next subsequent candle, right, we essentially have a down close candle right here. This is the more aggressive entry for the short positions. You can risk the highs right after we have the confirmation, and then we end up targeting this 904 level, which is this previous day high level, which also coincides with this gap fill on the higher time frames, right? And now we can play out the tape. And right there, right, you can see that we end up coming down back down perfectly to where that previous day high level, which also coincides with the gap fill. And that's why I always talk about these key levels. If you guys do want to know how I draw these key levels, you guys can always watch my old videos, right? I always talk about these key levels and talk about these gap fills. So make sure to check out my other videos if you guys do want to learn how to draw key levels. And as you can see right here, right, we have a perfect rejection off this level, and then you can see that this candle, right, comes all the way back down, and it signifies that it potentially has buyers in store. On NVIDIA, as you can see right here, you can see that buyers were present right around this 904 level, and you can see we're now having a push up. With this being said, now I'm going to be going to my third example that I have for us today. My third and final example that I have for us today is on the ES, and you can clearly see that we're in bullish structure, right? We're clearly making higher highs, higher lows, right? And we have this all-time highs level, which is that 5094 level that we're going to be looking to target. So we want to be marking out key levels as always, right? This is a very key level. If you look on the weekly time frame, you can see that this is a very key resistance level that we just swept. So now what we're going to be looking for is a potential retest of this key resistance level. We want to see it act as support for moves higher. So now we'll be going to the daily chart, and we'll be waiting to play out the tape. You can see that price comes back down. You can see that price ends up signaling a very strong hammer candle. So right here, when you see a hammer candle right here, you can either have an aggressive entry right here, or you can wait for a potential 3-bar continuation towards the upside. So you can see this very nice candle, right? It comes back down as well, right? Holds this level, right? You can see the bodies are holding this level. The wicks do the damage, bodies tell the story. So you see right here, a very strong confirmation candle. So this would give me the confidence that price wants to head towards all-time highs. So you can end up taking a position right here after this candle closes with stops below and targets being that all-time highs level and above. And now you can play the tape. And you can see right there, right? A perfect example of how you can use candlesticks in combination with price action in your strategy and liquidity levels to help you make money in the markets. I'm going to be breaking down my simple top-down approach to show you guys exactly what I'm looking at coming into market open every single day. So without further ado, let's get straight into the video. One of the most important concepts you guys have to understand is the top-down approach. If you guys are trying to capture these big moves in the markets, understanding the top-down approach is very crucial to capture these higher time frame moves. So essentially what the top-down approach is that you want a bigger outlook on the market. Whenever you're on the lower time frames, let's say the 1 or 5 minute chart, you're never going to be able to capture these big moves in the markets because you're so focused on these minuscule time frames. Whereas if you start off on the higher time frames, such as the weekly and daily time frame, you have a bigger picture of what the overall trend of the market. If you start off on the daily time frame, you're going to have a bigger lens, right? A bigger scope of what the general price wants to do on the higher time frames. You want to understand if it's bullish, if it's bearish, if it's consolidating, and then you want to be going on to the lower time frames, such as the hourly chart and then the 1 and 5 minute to look for those entries. So you want to start off on the higher time frames and then you can go on to the lower time frames. This can be applicable to anything that you do. Whenever you're so focused on the little time frames, those day-to-day actions, in the general scheme of things, the lower time frames should not have a significant impact on price. That's why we have the top-down approach, and that's why I use the top-down approach every single day when it comes to the markets. So let's go on to some examples and see exactly how I use my top-down approach when it comes to trading. So before I head on to some of the examples that I have for us today, I just want to let you know all the examples that I'm going to be talking about today. I either talked about it in my pre-market prep where I go over exactly what I'm looking for coming into the day every single morning for free on YouTube. If you guys do want to check that out, I'm live every single day at 8 a.m. Eastern Standard Time every single morning going through my top-down approach. So I'm just letting you guys know that the examples were done in real time and not hindsight, as well as a few examples. I'm going to be showing you guys the trades that I took in real time as well. So let's get right into the charts. So as you can see right here, we're on the weekly time frame on Google, and you can see that we're clearly in an uptrend, right? We're above this all-time highs level all the way back from 2021, and you can see we end up getting above it and using this as support for a move towards the upside. So now, since we're on the daily time frame, we're going to be marking out key levels as well. Right here, we can mark out some key levels on Google on the daily time frame. These are just some of the old highs that we've made on Google, right? This was that earnings gap that it made all the way back from May, and of course we can mark out this key pivot high as well. Now we can go on to the lower time frames, to the 1 hour time frame. Now you can see I'm on the 1 hour time frame, so I can refine my levels. I'm going to be drawing this key pivot high all the way back from April. I can also draw this key pivot high as well. As you can see, currently we're having a reaction off of this 182 key area, just consolidating right underneath that all-time highs level. I can also mark out and refine this into an area where there's multiple touches. You can see 1 touch here, 2 touch, 3 touch, 4 touch right here, 5 touch, 6 touch, and now we're basing above this level and trying to use this as a break and retest level. So right now we're on the 5 minute time frame, and you can see that we're clearly forming this wedge pattern that we have. We have that big push up towards the upside. Now we're basing above our key levels, which is the 180.20 level on the higher time frames. We're consolidating right underneath this key level as well, which is your 182.06. And of course, we have our all-time highs level, which is that 183.61. So coming into market open on Google with this downtrend break in mind, we either want to see two potential scenarios. We want to see a potential hold, right? A dip and rip in a hold of this 180 level for a push towards the upside, or you want to see a push above your key level, which is your previous day high level, and you want to see this used as a retest for a move back towards your 183, which is your all-time highs level. So as we play the tape here, you can see that price right off the gates, we're trying to close above this key level, which is that 182, and you can see so far we're getting a couple rejections off your previous day high level. So what you want to see is a strong candle closure above this this level, and you can potentially use this as a retest for a move towards the upside. So right here, you can see we still have not closed above our key 182 level. Now what we want to do is wait for a strong candle closure above this 182 and then look for a potential retest. So right there, you can see we finally have that strong 5-minute candle closure above your key level, which is your previous day high. So now we can go onto the lower time frames to look for areas of potential entries to target this 183 level, which is that all-time highs. So right here, you can see we're on the 1-minute time frame now, and the areas that we can have marked out is this down close candle, which is an order block, and then we also have your key level, which is your 182 as well. So now what we'll be doing is looking for a retest of this order block. As you can see right there, price ends up tapping into your order block very nicely, also coincides with your key level being 182. This is where you want to look for entries with a stop just to break below that 1-minute order block, also your key level, which is your 182 previous day high level, and then your targets in this case will be that next external level being that all-time highs level on Google. So as we play the tape here, so as you can see right there, that was a very nice push towards that 183 level, which also coincides with your all-time highs play. So as you can see right there, as soon as we had that 5-minute candle closure above your previous day high level, the next level market was going to gravitate towards was that all-time highs level. These all-time highs plays are seen off the higher time frame. So if you're strictly on the 1 and 5-minute time frame, you'll never be able to capture these type of moves. These type of moves you're able to capture if you see what's developing on those higher time frames. And as you can see, Google, right, we had that 5-minute candle closure above previous day high, so you want to look for that 1-minute break and retest for a move towards the upside, and you can see that's exactly what we got, and we had that push all the way towards that all-time highs level. So with this being said, let's go into the next example that I have for us today. Right here, we're on the Tesla weekly chart, and what we're going to be doing is a full top-down analysis and exactly what I'm seeing all the way from the weekly all the way down to the lower time frames. So you can see right here what we're forming on the higher time frames is this huge wedge pattern that we have on Tesla. You can see we have multiple touches all the way back spanning from 2021 on Tesla, and you can see there's multiple touches towards the upside. And you can see this is the bottom of the trend line as well. So you can see this wedge pattern is very much intact, and now we're going to be going on to the lower time frames. So you can see now we're on the daily time frame on Tesla, and what we're going to be doing is marking out key levels. The key area that I have marked out on Tesla right here, you can see there's multiple touches, right? This is essentially your flip zone that I talked about last week. This is a key break and retest level. You can see there's multiple touches towards the upside and towards the downside as well. So you can see right here, what we also have is this downtrend break on Tesla. We also are forming what's called an inverse head and shoulders on the higher time frames. So on the daily chart, we have an inverse head and shoulders. We also have this downtrend break as well. We have clear targets towards the top of the trend line where we just bounce off of the weekly trend line on the bottom, and we have room all the way towards the upside. So you can see we're now on the 1-hour time frame on Tesla, and what we can do is refine our trend lines. So you can see right here we have a wedge forming on Tesla. We also have the bottom of the wedge as well. So right here you can see that we're consolidating above our key level now. So you can see this is our 180 flip zone that we have. Price ended up breaking above and essentially using this as a retest. It's forming a wedge towards the upside. The higher time frame is starting to flip bullish. We also have news coming up as well, so this potentially can be a catalyst for a big move towards the upside. So right here now we're on the 5-minute time frame, and we can even mark out more key levels, one being your previous day high, and we can mark out this key pivot high back from Monday as well. So what we'll be doing coming into market open is we'll see if Tesla wants to show strength and potentially have a strong push above your previous day high to retest these levels for a push towards the upside. So as we play the tape here, so you can see in the first 10 minutes here, Tesla is showing extreme strength here, right? It's closing above your previous day high, and it's gravitating towards that key level being that 191 on the higher time frames. So now let's go on to the 1-minute time frame where you can look for potential entries where you can enter Tesla on. So you can see Tesla within the first 10 minutes is showing extreme strength. We're above our key levels, our previous day high, we're above our key 188 level, and now we're above our 191.59 level as well. So what we'll be doing is looking for these levels to be used as a potential break and retest opportunities for more pushes towards the upside. So as we play the tape here, you can see that price ends up gravitating towards the upside, right, we have valid displacement on Tesla. We also formed what's called this 1 minute order block. So we have this 1 minute order block that coincides with our key level being that 191. So we'll be looking for this area as a potential retest where you want to have a stop just to break below, and you want to look for that next target above. So as we play the tape here, so you can see this is where we look to enter in on Tesla with a stop just to break below that 1 minute order block. And our targets in this case are going to be those higher time frame levels and above. And you can mark out this key pivot high at 193. You can also mark out this key pivot high at 197. And of course this high, which is your final target at 198. So we go back onto the lower time frames, and these are potential areas that we can look to target on Tesla. So as we play the tape here, you can see that price ends up tapping into our order block very nicely. We would end up taking some off as it hits high of day, and we would be looking to leave trailers all the way towards the upside. So right there, you can see price ended up taking a while, but you can see that's why we look to take partials off at high of day and key levels. So you're able to hold for those bigger picture moves towards the upside. You can see Tesla ended up gravitating towards that next level, which is that 197. And I personally ended up holding a couple contracts for overnight as well, just due to the higher time frame breakout and a bigger push towards the upside. So with that being said, let's go into the last example that I have for us today. So the last example I have for us today is on AMD. So as you can see, we're on the weekly chart as always, and we're going to mark out key levels. As you can see, this is a very key previous all-time highs level used as support for a move towards the upside. And now you can see we're really just consolidating around this level. So that's why this is such a key level. Now let's go on to the daily time frame. So right here, you can see we're on the daily chart on AMD, and where we can refine is our key flip zone. You can see there's multiple touches right here. Right, we've been using this as support and resistance a lot of the times. What we're also forming is this wedge pattern on the daily time frame as well. So this is what we have coming into AMD. And now let's go on to the 1 hour time frame. So right here, you can see we're on the 1 hour time frame. We just bounced off the bottom of the trend line. So if you want to see price potentially push back towards the upside, you wanted to see it get above previous day high and potentially use this level as a retest to get back towards the top of your trend line and potentially these key levels and above. So right here, we're on the 5 minute time frame, and we can really mark out this key pivot high all the way back from a few days ago. You can see there's multiple touches. So this is the area that I broke down from. You can see there's 3 touches right here and 4 touch in the pre-market as well. So if you want to see AMD potentially move back towards the upside, you wanted to see it reclaim this key area, and then you wanted to see a retest, use this level as a retest for a push back towards the upside, towards the top of your trend line. So as we play the tape here, you can see AMD right off the gates is showing extreme strength. We're above our key level, which is that 160.80 level, which is that previous resistance, now should act as support. You can see there's extreme strength within the first 10 minutes. So we'll be looking for pullbacks on AMD now. So since AMD has had such big push towards the upside, we're going to be looking for potential areas to retest, right? This area, if it pulled all the way back down into 161, the momentum would really be gone after such a big push. So what we're going to be looking for is these down close candles, which is an order block, and these levels should be used as a retest for continuation towards the upside. So you can see as price ends up tapping back inside of the order block, you can see price ends up holding this order block very nicely. That's where I look to get in with a stop just to break below the order block. And in this case, my targets were old highs on the 1 hour time frame. You can see I marked out this key pivot high. I had this key pivot high, which is at 164.38. I also had 166 marked out and then 167 marked out as well. Now we can go on to the lower time frames and extend this all the way towards the upside. We can play the tape. Price ends up tapping our first profit target. That's where I look to take some off, but we're looking for our key targets above as well. It hit our second profit target, which is that 164. And you can see price end up tapping our third profit target, which is that 165. And then eventually price never ended up gravitating towards that 166 level and ended up stopping the rest out of my trailers. As you can see, this trade ended up playing out very nicely towards The upside, chances are when you first start trading, every time you enter into a trade, it seems to perfectly stop you out right before it shoots to your target. And the most frustrating part is that you were right, but you ended up losing money. So in today's video, I'm going to simplify liquidity, how you can use liquidity in the markets, and how you can implement liquidity into your own trading to make consistent profits. So understanding liquidity is very important when it comes to trading in the markets. And what liquidity refers to is the ease at which an asset can be bought or sold. So whenever we trade in the markets, what we need is what's called liquidity. And essentially, in the most simplest terms, liquidity really means just where is the money lying in the markets. If you can understand where the money is lying in the markets, then we can either look to take trades up into that area or look to sell in those areas. So the main thing is understanding where the money is in the markets. And if we can understand where the money is in the markets, and also what we understand is that whenever we have a buyer, what we have is a seller. So whenever we take a trade in the markets, someone is taking an opposing trade in that opposite direction. This can be a retail trader, this can be institutional money. Whoever is fulfilling our orders, right, either buying or selling, there's someone else on the opposite side of the markets. And really, there's only three types of liquidity that can be deployed in the markets. And this comes from one of three things, being entries, stops, or take profits. So whenever we enter in the markets, that's a form of liquidity. Whenever we get stopped out of the markets, that's also a form of liquidity being deployed. And of course, when we take profits, we're looking to take liquidity from the markets. So with the basics of liquidity down, let's go on to where is liquidity resting in the markets. And understanding where liquidity is resting in the markets is very important. As I mentioned in the last slide, if we can understand where liquidity is resting in the markets, we can look to take our entries, our stops, our profit targets. We can look for plenty of opportunities around these key areas. So the first thing that we're going to be looking for is external liquidity. So what I consider external liquidity is liquidity that's not inside its current dealing range. And majority of the times when we're intraday traders, we're looking for previous day highs and previous day lows. So what we're looking for is liquidity resting above previous day highs and below previous day's lows. So these are where key levels of liquidity are resting, which is above and below your previous day's highs and lows. The next one being old highs and old lows. Look left for old highs and old lows for targets. Liquidity rests above and below those key levels. So if we're not looking for your previous day highs or your previous day lows, what we're going to be doing is looking left to look at really the third one, which kind of coincides with the second one, being higher time frame key levels. So key levels I can see on the multiple time frames, the weekly, the daily, the hourly. This also coincides with really your old highs and old lows. So these two are essentially together, right? Old highs, old lows, higher time frame levels. These are essentially the exact same thing. And what we want to do is look left for those higher time frame objectives, and we know that liquidity is resting above and below those key levels, being those higher time frame key levels where there's multiple touches, right? Those old weekly levels, those daily levels. That's why you see price always gravitating back towards those levels, because what's resting there is what's called liquidity. So now we can go and see what liquidity looks like in the markets. So what does liquidity look like? So liquidity can come in forms of three ways: equal highs and equal lows, trendline liquidity, and range liquidity. First, let's start off in equal highs and equal lows. As you can see here, what we have is two equal highs. We have two equal highs here. What's built up above these highs, it's what's called liquidity. A lot of times whenever we have equal highs in the markets, we usually like to seek that liquidity because you know there's going to be some type of orders resting above those levels. Same thing with equal lows. As you can see right here, what we have is equal lows. A lot of times what will happen is price will usually gravitate back down towards those key levels because we have liquidity resting below those equal lows. Next, what we have is trendline liquidity. Whenever we have a trend line, this comes in form of multiple touches. I like to use at least 2 to 3 touches, and you'll see a lot of times whenever you have a trend line, price then breaks through the trend line and gravitates back towards the downside to take out the key objectives, because what we have is called trendline liquidity, and there's a lot of liquidity resting below those highs and lows, and price usually likes to take them up. And finally, what we have is range liquidity. So range liquidity essentially refers to the range that we're in between the key support and resistance levels. When we're in a range, a lot of times we're taking out the high and low of the range. We're coming back inside of that range slash consolidation because what we have is range liquidity and it just likes to take out both highs and lows of the markets. So now let's go on to a little bit more detailed explanation of what these look like. So now we're back on the line chart and I really want to talk a little bit more in depth of what equal highs and equal lows looks like. So right here you can see what we have is equal highs, right? We're in an uptrend, higher lows, higher highs. What we have is equal highs right here at this pivot high. So whenever we have equal highs, what's resting above these two highs is what's called liquidity, right? This can come in forms of buy stops, right? This can come in forms of sell orders, but all we know is that there is liquidity resting above this key level. So a lot of times what will happen is price will look to trade back up in towards this area and take out the liquidity above these equal highs. So if we understand that price wants to gravitate back towards these equal highs, we can look for a trade up and towards this equal high, or we can wait for the break and retest of these equal highs for that continued push back towards the upside. So if we go on to the equal lows, as you can see as well, right, we're in a downtrend, lower high, lower low, lower high, and what we form is what's called equal lows. So we have equal lows, as you can see right here. What's built up underneath these equal lows is what's called liquidity. So if we understand this, price is going to want to gravitate back down towards this key area. As I mentioned, we could potentially look to take a lower high in towards this key area, or we can wait for, as I mentioned, the break underneath this key area, a retest of these equal lows for that continued push back towards the downside. So whenever we have equal highs or equal lows, we can look to take trades up and towards those equal highs and equal lows, or we can wait for a break above or below and look for the retest of those equal highs and equal lows. So now let's go on to trendline liquidity. As you can see, the next one I want to talk about is trendline liquidity, and we're making a low, higher high, higher low, higher high. And what we have is what's called a pullback. So you can see in this case, we're pulling back, we're creating a mini downtrend here. We're creating a mini downtrend in a macro uptrend. So you can see in this case, price is really just coming right back down and towards our key break and retest level. So you can see we have this downtrend line on the lower time frames, and we can mark this out. So we can mark this trend line towards the downside. So we understand that we're in a clear uptrend. We have a pullback down in towards our key break and retest level. We form a trend line, and what happens whenever we form a trend line, what we're creating is essentially lower highs. So we're creating lower highs, but what's above these old highs is what's called liquidity. So we have liquidity above every single high that we've put in. So whenever we have this, we're just building up liquidity for a fuel move really back towards the upside. If we can break structure, hold these key levels, this would be a bullish signal for price to really gravitate all the way back towards this key high, which would have been that final target. So if we understand this, what can we look for? If I clear this chart right here, we can mark out our clear break and retest level. What we're going to be looking for really is all these liquidity levels being built up back towards the upside. So on the lower time frames, what we're going to be doing is looking for a break of structure back towards the upside for that continued push back towards these highs. So let's say this is the 1 minute and this is the 5 minute. What we're going to be doing in the markets is waiting for that break of structure, a retest of this key level, and that continued push really back towards these highs all the way back here, which would be that key level. So this is a great example of trendline liquidity. Whenever we have a trend line in the markets, what we have is built up liquidity, and when we break that trend line, we're going to be looking for trend line liquidity. So now let's go on to the third type of liquidity, which is range liquidity. So the third type of liquidity is what's called range liquidity, and essentially what range liquidity is when price is inside of a range. So price is inside of a range. As you can see, these are our key lows, these are our key highs. And what usually tends to happen in range liquidity is price likes to take out the liquidity above these highs and then come all the way back towards the downside, sweep out these lows, and just come back inside this range. So this is what's called the range liquidity. A lot of times what will happen is that we'll end up taking the range towards the upside, fake out all the people that are trying to buy the breakout towards the upside, and they'll come back towards the downside and do the exact same. Fake out all the sellers that are trying to sell short towards the downside, we trap them, and then we come back inside the range. So this is what's called range liquidity. The only way I personally play range liquidity is when price creates a high and a low, and what we have is a break above the range with strong displacement, and then we have a retest of this level for that continued push towards the upside, or if price breaks back underneath the range, right, strong displacement, a retest of this level for a continuation back towards the downside. And the way to look for range liquidity, as I mentioned, is we need a break with strong displacement, and usually this comes in forms of higher time frame thesis, right? This happens on the higher time frames. If you can get a breakout on the higher time frames, that's usually a good indication if price is going to break outside of the range. Is first higher time frames, candle confirmations, displacement, and price action around the retest levels. So with this being said, let's go on to some examples that I have for us. So as you can see right here, what we have is the NVIDIA chart. What we have is equal highs. So if equal highs in the markets, and what's resting above these equal highs, as I mentioned, is what's called liquidity. So we have a lot of built up liquidity above these equal highs. So what I'm expecting price, right, as you can see right here, we're forming these higher lows. What I'm expecting price to happen is we have a big push towards the upside if we can break above this key area, which is our 502. And you can see the very next slide, price broke above these key equal highs, and what happened? We had a monster push towards the upside, and I was able to capture this retest on the lower time frames, but this was based off of a higher time frame thesis, right? We knew that we're bullish, we had clear equal highs, and we expected price to continue higher if we broke above your equal highs, and that's exactly what we did. Another example, as you can see right here, what we have is equal lows. We're on the NQ, and what's resting below these equal lows is what's called liquidity. And whenever we have these equal lows, price is going to want to gravitate down towards these equal lows and take out the liquidity that's resting underneath these key equal lows. And you can see price gravitating down towards these equal lows, taking out the liquidity right here, pop back up, and then we headed more towards the downside for a confirmation of this move lower. Next, what we have is trend line liquidity. As I mentioned, as you can see right here, what we have is this trend line. Right, whenever we have this trend line, what we have is built up liquidity. So we have a lot of built up liquidity on the NQ. So whenever price does want to move back towards the upside, we're going to have a nice pushback towards the upside because there's a lot of built up liquidity. As you can see, we're putting in those lower highs. So if price is bullish and we break structure back towards the upside, which we did, we're going to have a nice push all the way back towards these highs, just due to the fact that what we have is liquidity being built up towards the upside. As you can see here, this is an example on Tesla. What we have is liquidity being built up towards the downside. We're forming this downtrend, and you can see right here, we have multiple touches. So we have 3 touches. If price wants to break underneath this trend line, there is a good chance that price continues towards the downside because we have liquidity being built up. And as you can see right here, once price broke underneath this trend line, the key levels were these key liquidity levels being these key lows, and price ended up gravitating towards the downside because we had liquidity resting underneath every single low, as you can see right here. So let's go on to range liquidity. And as you can see right here, what we have is range liquidity. And you can see every single time price makes a new high, right, peaks above it, rejects off this level, and then gravitates towards the downside, right? The downside takes out the liquidity, fakes out the sellers, and then gravitates back towards the upside, takes out this high once again, fakes people out, and then gravitates all the way back towards the downside, right back towards our key area, and then it gets bought up and then moves back inside of the range. So this is what's called range liquidity. As I mentioned, the only time I'm looking to play range liquidity is when price breaks outside of the range with strong displacement, and we either get that continued push towards the downside, retest, and continuation, or price break above, retest, and they have that continuation back towards upside. So with this being said, let's go on to the trading view chart, and let's go over some examples in real time. So right here, you can see that we're on SPY. The key level that I have marked out is this 174. You can see this previous support turn into resistance. We're getting it back above this key area now. So we'd like to see this area be used as support. And the key areas I have marked out towards this upside are these key equal highs all the way back up at 485. And of course, this key high marked out as well. So looking at this chart, what we're going to be looking for is a potential trade opportunity up into this 584 level, or we're going to be waiting for that bigger time frame break above this 585, a retest of this level for that continuation back towards the upside. So if we understand that this is where the liquidity is resting in the markets, we can look to either target these areas, or we can look to use these as potential entry points. So let's play the tape out on SPY. So as you can see, coming into market open, we have that big push towards the upside. We're breaking above these equal highs. We're breaking above our key level as well. So we broke above this key area of resistance where all the liquidity is resting. Now what we'd be looking for is the retest of this level for that continued push back towards the upside. So now we can go on to the lower time frames. So as you can see, we're on the 5-minute chart, and based off of our higher time frame key levels, where we're going to be looking for potential trade opportunities down in towards this 585, 586 key area for a move back towards the upside. So we can play out the tape here. So within the first 30 minutes, you can see prices now gravitating right back towards the downside. As you can see, right, this is going to be the exact area that we're going to be looking for that continued push back towards the upside. So now we can go into the 1-minute time frame. So right here, you can see we just broke structure back towards the upside. We have a lot of displacement as well. So now what we'll be looking for is a retest of this 586 for that continued push back towards the upside. So now you can see we have a nice reaction off the top of our break and retest level. So now we're going to be looking for that reversal play back towards the upside on this buy. This is where I look to get in with a stop just to break below, and I'm looking to target your opening candle range, your high of day, and your pre-market high. So I can drag this all the way back towards the upside and mark out the key levels. We can now go back onto the 5-minute time frame since this is based off the higher time frames. And you can see right there, price ended up hitting all 3 profit targets. I took some scales right here and I ended up moving my stop to break even. Almost got stopped out on the remaining contracts of my position, but I ended up holding this key area that I bounced off from the first time. And then we ended up having a nice move back towards high of day and then your pre-market highs. And of course, SPY also had continuation above as well. So this is a perfect example of understanding liquidity on the higher time frames and using that liquidity area as now as a retest for that continued push back towards the upside. So now let's go on to the second example that I have for us. So right here, you can see I'm on my second example and we're on NVIDIA. As you can see, what I have drawn out is this trend line: 1 touch, 2 touch, 3 touch, 4 touches, 5 touches. So we have a lot of touches on this trend line. And now you can see we're trying to break out on the 1-hour time frame. So what we'll be looking for now is the retest on the lower time frames for that continuation move back towards the upside. So you can see that coming into market open on the lower time frames, we're trying to break above this 5-minute opening range. You can see on the very next candle, we're breaking above this key area. So now we can go into the lower time frames. So right here, you can see we're on the 1-minute time frame, and the key levels I'm going to have marked out now is your order block and also your 1-minute and 5-minute opening range. So I can mark out this key area, drag this over, and now what we're going to be doing is looking for this area to be used as a retest, right? The trend line retest, your opening range retest, your order block retest, right? This is a high probability area for NVIDIA to gravitate back towards the upside. So you can see that price is tapping in towards this key area. Right here, this is our confirmation candle that price wants to gravitate back towards the upside. We can get in with a stop just to break below. In this case, right, we can either look for high of day. In this case, it's only a 0.9 risk reward ratio. So we'll look for a 2-to-1 and continuation towards those higher time frame levels. So if we zoom out a little bit here, the key levels I can have marked out. In this case, we already hit your previous day highs. So you can mark out the next key levels, which is your 139 and then your 140 towards the upside. So we can drag this over and move this back towards the upside and play it out. And you can see right there, price ended up hitting our first key area, also hit our 139, and most likely I would have ended up getting stopped at the rest of my contracts once it broke back underneath this 139.82 key area. This is a great example of the trend line on the higher time frames, and then we go into the lower time frames to look for our entry models, in this case being the 1-minute opening range, right? We also had a 1-minute order block. We also had a retest of the trend line as well in the higher time frames, and then we're looking to target those external levels back towards the upside. So now let's go on to the final example that I have for us today. As you can see right here, we're on my final example, this on SPY. You can see we're clearly inside of a range, right? We're making highs, we're making lows. You can see every single time price comes near these lows, right, we're sweeping these levels, reversing back towards the top of the range. And once we get towards the top of the range, right, we're reversing back down in towards the middle of the range and the low of the range as well. So if I'm looking to trade range liquidity, what am I looking for? I know that there's liquidity built up to both sides of the markets. So what would I be looking for on the higher time frames if I'm going to look to trade this? I'm either going to be looking for a break underneath the range with displacement, a retest of this key area for more continuation towards the downside, or what I'll be looking for is a break above with displacement, a retest of this key area for that continued push back towards the upside. So let's play out the tape. So you can see right here, we're finally getting that break back towards the upside. We have a lot of displacement. You can see we have a daily candle closure as well. So now what we're going to be looking for is the retest of our 570 for that continued push back towards the upside. So now we can go into the lower time frames. So right here, you can see we have that big push towards the upside with displacement. Now we're looking for the retest of this key area. You can see we're tapping it in the pre-market. So what we want to see is a hold of this 574 for that continued push back towards the upside. So you can see right there, price tapped in towards our 574. That's our key area. You can see we have a 5-minute candle confirmation as well. That's where we can look to go long with a stop at low of day. And now we can target a 1 to 2 back towards the upside. In this case, it basically coincides with your pre-market high and your previous day highs as well. So we can mark this out. Now we can play the tape. And as you can see right there, price ended up having a nice move back towards our pre-market highs and our previous day highs for a nice win on spot. If you truly want to see success in the markets, but constantly find yourself getting stopped out on the wrong side of a trade, chances are you don't understand market structure. Until you understand how price moves in the markets, you're not going to be able to make consistent profits. So in today's video, I'm going to break down my 3 core principles of market structure to help you guys become profitable traders. So we're going to be talking about market structure today, why it's so important to understand market structure, how to identify market structure, and how you can use it to make money in the markets. So as you can see right here, what I have is my 3 core principles to understanding market structure. Number 1, the first thing that we want to look for is identifying trends in the markets. So the basics of market structure is being able to identify trends. If we're in an uptrend, if we're in a downtrend, if we're consolidating, this is the basics of market structure, is being able to identify these trends on the higher time frames. Next, what we're going to be looking for is determining the difference between a fake out versus a continuation. A lot of times the setups look fairly similar, especially on the lower time frames, but there's a key difference between a fake out versus a continuation, and I'm going to talk about it a little bit deeper later in this video. And then finally, what I have is understanding the difference between micro and macro trends in the markets. There's differences between a macro uptrend with a micro downtrend. That's what we're going to be talking about, and why it's important to identify the difference between macro and micro trends in the markets and how we can use them to make money. So now let's go on to identifying trends in the markets. So as you can see right here, what we have is basic market structure. So in this case, on the left-hand side, what we're creating is higher highs, higher lows, higher highs, higher lows, and we're continuing towards the upside. So this is what's called an uptrend. And whenever we break above this key level, this is what's called a break of structure. So a break of structure occurs in the direction of the trend. So every single time it breaks above this key swing high, this is a break of structure towards the upside. And once again, once we break above this key swing high, what we have is called a break of structure. So when price is continuing to make higher lows in the market, this is when we know when we're in a clear uptrend, versus when we're on the right hand side where price is making lower highs, lower lows, lower highs, lower lows, lower highs, and we're continuing towards the downside. In this case, what we have is breaks of structure towards the downside. In this case, the trend is towards the downside. So every single time it breaks below this key swing low, right, what we have is a break of structure continuing the trend towards the downside. So in this case, we're making lower highs, right, lower lows, and lower highs, and we're continuing towards the downside. So clearly we can see on the left hand side what we have is a clear uptrend in the market, and on the right hand side we have a clear downtrend in the market. And of course, right, this is the basics of market structure. And you might be asking, price doesn't always look this clean, and you are correct. So you can see the reality of market structure is that price is not always going to be super clear. So you'll see that price is not always in a clear trend towards the upside or downside. And this right here is usually the reality of market structure. It's not always going to be the cleanest on the higher time frames. So let's break it down and see exactly what we're looking at. So you can see right here, what we have is a clear trend towards the upside. We have higher highs, higher lows, right? We're breaking structure. This is a clear trend towards the upside. We have a break of structure. We're creating a new high. We have another low put in, and now you can see right here, we make a lower high. So we make a lower high right here, And then what we have is price is technically breaking underneath this swing low. So we break underneath this swing low, but you can see price is still bullish on the higher time frames because we're still making this higher low off this key pivot point. So you can see that price, as long as we maintain above this key area, we're still in what's called a bullish uptrend. So we're still in a bullish uptrend, and you can see price, we finally break structure back towards the upside right here. This right here is what's called our break of structure. You can see price, we make a new high, right? We're creating these higher lows, right? We're building up towards the upside. Similar thing once again, price breaks underneath this key swing low right here, but you can see that price is still holding our higher low key pivot areas. So you can see price creates a double bottom, right? In an uptrend, double bottoms are very bullish, and we're continuing towards the upside. You have another break of structure back towards the highs, and we finally make a new high. In this case, price pushes towards the downside, right? We're still very much in a bullish uptrend all the way up until the end where we break underneath this key low right here. Once we break underneath this key low, which is your double bottom, this is now what's called a change of character, right? So every single time before, when we're having these mini breaks of structure towards the downside, we're still in a very clear uptrend. But in this case, we finally break underneath this double bottom, which signifies that price is starting to head in a potential downtrend. So now this is what's called a change of character. Breaks of structures are continuations of trends. Changes of characters are a break of a trend. So in this case, price breaks underneath this double bottom. So now what we can see is a potential downtrend in the overall markets. So let's go on to the next slide. The next slide I want to talk about is strong versus weak structure. As I mentioned in the last slide, sometimes structure is not always perfect, but how can we identify strong structure versus weak structure? In this case, what we have is strong structure on the left. So in this case, what we have is a clear uptrend once again. Clear uptrend, higher highs, higher lows, higher highs, higher lows, higher highs, right? This is what's called strong structure. When price is using these key previous resistance turn into support levels and we're holding these key areas, this is by far the most bullish. Or vice versa towards the downside, when price is using those support levels turn into resistance, that's when we have strong structure towards the downside. And you can see once price right here, we break structure towards the downside, right? We're still in an uptrend, as we can see right here. We're still in this uptrend because we're making a higher low off this area. As you can see right here, price fails to make a new high, right? Price fails to make a new high. And now you can see what we're having is a lot of internal liquidity, right? Price is breaking above the high, right? Taking out the liquidity, just coming back inside the range, not really too much displacement. We're just coming back. We're still in an uptrend, but we're slowly making its way towards the upside. And that's not what we like to see when we look to trade. What we look for is strong structure. We like to see displacement where price has a nice push above the swing high key pivot point. If price breaks above the swing high, but quickly reject, that's potentially what's called a fake out, which I'm going to talk about next as well. And right here, this is going to be the difference between a fake out and continuation. So you can see price moving towards the upside, higher highs, higher lows, higher highs, higher lows. We end up using this area as a retest. Price breaks above this swing high, but fails to have a candle closure, fails to displace above this level. We reject, sellers start stepping into the market, and now we take price towards the downside. Whereas on the right-hand side, what we have is continuation, where price is making higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. And we're holding these key areas of break and retest. And you might be asking, how do we determine the difference between a fake out where it goes to take out liquidity versus continuation where we have markets holding key areas in the trend of the overall market? As you can see right here, the main thing is understanding the higher time frames. So you can see the higher time frames in this case is bearish. We're making a lower high, lower lows, lower highs, lower lows, lower highs, lower lows. In this case, what we have is a mini uptrend. So now you can see price, we push back towards the upside. We finally have our change of character, a break of structure, and now we have our retest. So as you can see right here, this is now a miniature level of resistance turning into support. This might look like a super solid buying opportunity on the overall market, but you can see if we are going to look to buy in this area, what happens? Price has that push up. We take this swing high out, but what happens? We sharply reject off this area and we end up continuing towards the downside. The reason being is because you can see the overall higher time frames. Price is really just returning back into this higher time frame break and retest level. Your previous support really acting as resistance, and you can see this would actually be a really solid area where you should be looking to take a sell position towards the downside. So you can see in this case we have a lower time frame break and retest, but the higher time frame is bearish. So if we don't understand the higher time frames, it's going to make it very difficult for us to trade in the markets. And now you can see the exact same thing, but now this is a continuation, right? The difference between the two is that in this case, right, the higher time frames is bullish. As you can see right here, we're creating an uptrend where we're creating higher highs, higher lows. As you can see, right, we're creating this double bottom in an uptrend, and price in this case is using these key areas of break and retest. You can see price where we're coming back into key areas of break and retest, another swing high made using this area as support for that continued push back towards the upside. And the reason why we have continuation is because the higher time frame is bullish. These dips are most likely going to get bought up because we're in an uptrend. If we're in an uptrend, we can expect every dip to get bought up and create higher lows in the markets. If we're in a downtrend, we can expect most pops to get sold to create a downtrend. So as long as we understand the trend of the markets, we can capture either the upside or the downside. We don't have to worry about if price is trending towards the upside or the downside. As long as there's a trend in the markets, we're looking to capture a move within the trend of the market. So now let's go on to micro and macro trends. So now let's look at micro and macro trends. As you can see right here, we have another clear uptrend in the markets. We're creating higher highs, higher lows, higher highs, higher lows. What we're going to be looking for is this previous swing high to now be used as support for that continued push back towards the highs. So you can see in this case, what we have is a 1 hour chart. And on the right hand side, what we have is a 5-minute chart. So you can see I have this color coded here in red. This is the mini downtrend. So you can see in this case, what we have is a macro uptrend where we're creating higher highs, higher lows. We're continuing towards the upside. But what we have is this leg in price right here, which is color coded in red. So this is on the 1 hour time frame. On the right hand side, if we're having a pullback on the 1 hour time frame, what this is going to look like is a downtrend on the lower time frames on the 5-minute or the 1-minute. So you can see in this case where we're creating lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and we're coming back into key areas being that higher time frame point of interest. So you can see the blue line will be your key level of resistance turned into support on the higher time frames. So this is the area we're going to be looking for potential reversals in price. When price taps back into our higher time frame break and retest level, we're now going to look for signs that price is going to flip back bullish on the lower time frames. So we know that the higher time frames is bullish and we have a mini downtrend on the lower time frames. We're going to look for a change of character on the lower time frames to now flip back bullish. So you can see in this case price, we have that change of character as you can see right here in price. When price breaks back above this swing high, price now flips back bullish. And now what we're going to be looking for is any sort of key areas for that continued push back towards the upside. So this is basically what my model looks like, right? Once we break structure, as you can see right here, we're going to be looking to trade price back up in towards our key areas, risking off this key swing low. So on the higher time frames, what it will look like is this nice break and retest on the higher time frames with a stop just to break underneath this key area. So essentially what my strategy is looking for these macro uptrends, and I'm looking for micro downtrends to flip back bullish. So I start having a micro uptrend in a macro uptrend, And that's when everything starts aligning and I can look to target those higher time frame key levels. So now let's put this all together and go look at some examples in real time. So right here, you can see that we're on SPY and we're going to analyze the market structure on the higher time frames. And then we're going to go into the lower time frame to see how I trade this in real time. What you can see right here is that we're in a clear downtrend in the overall markets on SPY, creating lower lows, lower highs, lower lows, lower highs, lower lows, and we're continuing towards the downside. So in this case, the key level for SPY is going to be this key area right here, right? This is your change of character level, your previous support turned into resistance. If SPY can break back above this key area, then we can look for a potential move back towards the highs, towards your key levels towards the upside. So now let's play out the tape on the higher time frames. So you can see right here on the overall market, price is no longer bearish. We reclaim this key area on SPY. We're no longer bearish, and now we're going to be looking for that continued push back towards the upside. So now you can see we have that big push coming into pre-market. We have a clear uptrend. We broke structure back towards the upside. We're above our key swing high pivot point now. So what are we going to be looking for? This was our original swing high pivot point. Now we're going to be using this area as potential support for that continued move back towards the upside. So now we can play the tape coming to market open. So you can see right here coming into market open, we're very much bullish. So we're bullish now on the higher time frames. We're in a very much clear uptrend. What are we going to be looking for? Our key areas is all the way down towards our 586. So we know that this is a higher time frame point of interest. We're going to be looking for this area to be used as support for that continuation back towards the upside. So as you can see here, as we play out the tape, price is now pulling back down in towards our key area. So the higher time frame is bullish. We have a 5-minute downtrend. If I go into the 1-minute time frame, you can see we have a 1-minute downtrend as well. So what do we have here? We have a higher time frame macro uptrend, and now we have a micro downtrend on the 1 and 5-minute. So now we're going to be waiting for the 1 minute to flip back bullish for a push back towards the upside. As you can see right here, this is where we get that change of character back towards the upside. We break above this swing high. Now what we can look for is all dips to get bought up for that continuation push back towards our higher time frame objectives now. So now we're going to be looking for the retest. You can see price, nice reaction off our key retest level. That's where I look to get in with a stop just to break below. And now I can look to target those higher time frame key levels. So if I move back on the higher time frames, in this case, my higher time frame key level, since we're at all-time highs, is going to be this pre-market high all the way back here. So this is going to be my key area for SPY that I can look to target. Now we can go back and play out the tape. So as you can see right there, SPY ended up hitting my main target, which was my pre-market high, or that all-time highs level that I made in the pre-market. In this case, I actually ended up taking a couple scales along the ways, but I ended up holding my major position for that higher time frame key level. So in this case, it would have netted me $1,800. What I actually made in this day was over $6,000. So now we can continue to play the tape on Tesla to see what it will look like on the next session. So you can see I played the next session towards the next day. You can see we're still clearly in a higher time frame bullish environment. We're creating higher highs, higher lows. We're holding key areas on the SPY. What we're going to be doing is looking for continuation towards the upside, right? We have a higher time frame macro uptrend. What are we going to be doing? We're going to be looking for any sort of micro downtrends to flip bullish to target those higher time frame objectives. So in this case, so as you can see right here, I'm on the 5-minute chart, and I'm going to mark out a couple key levels. I'm going to mark out your previous day highs, and I'm also going to mark out your pre-market high key area as well. In this case, right, as I mentioned, higher time frame, bullish uptrend. We're now looking for any sort of pullbacks on the lower time frames or for any sort of bullish setup for continuation higher. Now I'm on the 1-minute time frame. You can see that price is now using our opening range candle, right? Pre-market high. We're getting above this key area. Let's see if we can end up using this area for potential continuation back towards the highs. So yeah, price, we have a nice break towards the upside. We're getting the buyers stepping in off our opening candle print, off our key area as well. This is where we can look to take price with a stop just to break below. And we can look in this case, right, since we don't really have any targets, since we're at all-time highs, we can target a 1-to-2 risk to reward ratio. And you can see right there, price ended up hitting our target fairly nicely for another win on the day. But let's go on to the next session. So as you can see right here, we're on the next day again, and we're still in a very much clear uptrend in the markets. So if we're in a clear uptrend in the markets, what are we going to be doing? We're going to be looking for long positions towards the upside. Since the higher time frame is still bullish, we're going to be looking for continuations higher. So you can see that coming to market open, the key level that I'm going to mark out is this key area, which is your previous day highs. We can also mark out our key area as well and drag this over. And now we can go into lower time frames to play the tape. So as you can see, coming to market open, this is our key area on SPY. What I really want to see is a break above this previous day high area for that continued push back towards the upside on the overall market. You can see that price is trying to close above this area. What I like to see is some displacement, a retest of this area for that continued push off your 496.65. So you can see we finally close above highs. What we can be looking for now is the retest. As you can see, we're getting the retest here nicely. That's where you can go look long with a position off this retest level with a stop just to break below. And you can look to target a 1-to-2 risk reward ratio. So you can see right there, we had another nice win on SPY towards the upside. The structure on the higher time frames was bullish. And now we go into the lower time frames to look for any bullish setup for continuations back towards the highs. So now let's go on to the next session on SPY. So as you can see right here, we're on the higher time frames. We're still in a very much clear uptrend on the overall market. So if we're in a very much clear uptrend on the overall market, what are we going to be doing? We're going to be going on to lower time frames to look for any micro downtrends to look for a continued pushback towards the upside. So now let's go into lower time frames. Right here, you can see the key area I'm going to have marked out is your previous day highs. So we're going to be using this area as a potential move back towards the upside. Coming into market open, so you can see price is now tapping into our key area, which is your previous day highs. So we'll be looking for potential continuations back towards the upside. So right there, we can look for a position off our key area, right? Nice reaction off this area. Stop just to break below. And in this case, we can look to target your pre-market highs back towards the upside and drag this up. Now we can play out the tape. You can see right there, we would have ended up getting stopped out for a loss. In this case, this was a super solid setup. This was higher time frame bullish. You had a nice strong reaction off your previous day highs, right? You're looking for continuation towards the upside. In this case, you're up 3 days in a row. Fourth day on SPY, you're bound to take a potential loss in this case, but this was a super solid setup. And now let's go on to the next session. As you can see, we're back on the higher time frames. We're creating higher highs, right? Higher lows, higher highs, higher lows. But in this case, what we have on the previous day is we actually broke underneath this key pivot point. So now we have to be very careful and we want to wait for extra confirmation that price wants to continue back towards the upside. So now let's go on to the lower time frames and we can mark out key areas. So I'm on the 15-minute time frame and we can refine our key areas now. So price, as I mentioned, we have to be fairly careful because now we're not above our previous day highs on SPY. And our key area now really of our level of support is all the way down towards this 596. So we can drag this level, refine our key areas and mark this out, which is our 496, multiple touches around this area. So what we want to be doing is really looking for price to come back in towards this level for potential kind of positions back towards the upside on the higher time frames. So let's go into the 5-minute and see that price is pushing towards the upside so far. What we have is a pretty big candle underneath your opening candle range low now. So what we can be looking for on the 1-minute time frame is a potential retest of this area for a quick scalp towards the downside. So what this is right now is we're looking for an intraday bearish setup to target those higher time frame key areas. So now let's look to see if we get that retest. Price coming back to retest this area. We'll wait for weak price action. You can see we get that weak price action off our key area. That's where we can look to go in short with a stop just to break above, and we can look to target low of day and continuations down towards our key areas on the higher time frames. Now play out the tape. And you can see right there, price ended up tapping into our higher time frame point of interest fairly nicely, where we would have ended up closing our short position because that was a higher time frame point of interest level. I turned $3,000 into $57,000 in 2.5 months. I'm gonna prove to you how it's not luck and why having the skill of trading is a lot more important than the amount of money that you have. The reality of trading is that you don't need a lot of money to make a lot of money. As long as you have a systematic approach with a positive expectancy and solid risk management, you will be able to make consistent money in the markets. I'm going to be showing you guys all my statistics, the exact strategy that I used to achieve these results, and some tips if I were to do this all over again. So with that being said, let's get right into the video. As you can see right here, I ended up making $50,000 net P&L. And if you go onto my regulated broker, this is Interactive Brokers, and I'm refreshing the screen right here. You can see the net asset value. This is a live broker statement. You can see I started off with $7,000. This day I actually started off with $3,000, ended off with $57,000 for a net return of 700%. And as you can see right here as well, I have every single trade that I took within that 2.5 month span to make me over $50,000. This is all the proof right here. This is a regulated broker. This cannot be faked. I showed you guys. I'm refreshing the screen. As you can see right here, everything is done in real time. Some things to note, this was done a few years ago when I was actually trading on lighter size. Now I personally have a larger account, so that's why I don't have these small account challenges. But if I were to start off a small account, it would be the exact same thing and the exact same approach that I would take today. So I'm going to be showing you guys how I would approach trading a small account. I'm going to talk about my stats, my risk management, risk reward ratio, talk about leverage, talk about my strategy, and how I would be able to replicate these results, maybe not in the exact same time frame, but how I would be able to do this if I started from scratch. So let's get into the video. As you can see, we're back on my TradeZella here, and I want to talk about some statistics that might shock you guys. A lot of people talk about win rate. You need to have a high win rate in order to become a profitable trader, and this is just not true. As you can see right here, I had a 38% win rate, and I ended up making over $50,000 with very minimal drawdown, as you can see right here. And I ended up doing this with around a 40% win rate. So as you can see right here, what I want to talk about is your risk to reward and some misconceptions when it comes to your win rate in trading. A lot of people think that you need a super high win rate, 80, 90% win rate in order to become profitable, but that's just not the case. As you saw on my statistics, I had around a 40% win rate with a 1-to-3 risk to reward ratio. This landed me in the green percentile, and this made it so I was a very profitable trader, as you can see right here. I had around a 40% win rate with a 1-to-3 risk to reward ratio. As long as you have statistics similar to those, you're going to be very profitable. As you can see, I also had very minimal drawdown, as you can see on my P&L graph overall. A lot of people think you need those high win rates, those 80, 90%. What comes with the 90% win rate is that you have a lower risk to reward. I personally like having those high risk to reward trades instead of having those super high win rate with a very negative risk to reward ratios. So that's one misconception that I want to talk about. A lot of people think you need a high win rate and you need it in order to become profitable, but that's just not true. So as you can see, we're back on my TradeZella now, and we had a 40% win rate, profit factor of 1.76, daily win percentage of 90%, and an average risk to reward ratio of 1 to 2.76. So that means for every single dollar I was risking, I was looking for at least $2.76. So this is my average risk to reward ratio, and that's why I was able to have a lower win rate, and I was still very much a profitable trader. Now I want to talk about the risk amount when it comes to being able to turn $3,000 into $57,000 in such a short period amount of time. To be able to achieve these type of results, you need to risk a decent amount of your position size. For me personally, the way I trade a $3,000 account is going to be a lot different than how a normal person would be able to trade a $3,000 account. For me, I was risking 5 to 10% per trade when I was trading that amount. To be able to risk 5-10% on $3,000, for example, let's say you're risking 10% on a $3,000 account. That means you're risking $300 to try and make $900. right? So you're risking a decent amount of your portfolio to make a decent amount. And that's what happens when you trade a small account. Obviously, I would not recommend beginners to do this because I had a proven system, I had proven statistics, and I was able to scale my account that quickly. But for a normal person, you only risk the amount you can afford to lose. A solid risk amount that we always tell people to trade off when you're starting in a beginner trader on a small account is you want to risk around 1% of your account. This means if you were trading on a $3,000 account, you would only be risking $30. In this case, the $30 would only equate to $90. So you can see right here, if you're risking 1% of your account, you're only going to be making $90 if you win. As in this case, I was risking 10%, so I was risking $300 to make $900. And you can see how that math works. If you risk more, you're going to be looking to gain more. And of course, if you lose, you're going to lose more on your account. Me personally, I traded with a $3,000 account how I would have traded with a bigger account, because I'm able to lose that money. If I lose the full $3,000, I don't really care if I lose that full $3,000. It doesn't really mean that much to me, right? This is not saying that $3,000 is a lot, right? $3,000 is still a lot of money, but if I lose $3,000, it's not the end of the world. Whereas if you trade, for example, with $3,000, if you need this money to pay your bills, to support your family, right? It's going to be a lot harder for you, emotionally speaking, to turn that $3,000 into, let's say, however much money you want it to, because you need that money. You're trading with money you can't afford to lose. In my case, it didn't matter if I lose the $3,000 because I'd still be fine. So in this case, I was able to risk the 5 to 10%. So I was able to make that $57,000. Some other stats I think is very important to understand is that majority of my trades were taken within the first hour to an hour and a half of market open. As you can see right here, most of my money was made during 10 o'clock to 11 o'clock a.m. That's where all my trades were taken. Whenever you're trading within the first hour, you have liquidity, you have continuation, you have a lot of volatility. So that's how I was able to capture and make all my profits earlier in the morning, right? Within the first 2 hours of market open. Something else that's kind of cool to note is that I did this all on one instrument. As you can see right here, I only traded Tesla. Tesla was the only ticker that I traded throughout this whole period. This was when Tesla had that huge bull run towards the upside. I was able to capture on this basically continuation almost every single day on Tesla, if it was either towards the upside or the downside. As you can see, I made all my money on one single ticker, which was Tesla. This is kind of cool to note that you don't have to trade multiple tickers in order to become profitable. I did this solely off one ticker. And this was just for the first 2 months. I ended up making well over 6 figures on Tesla in just this one whole year. Some other statistics that's kind of cool is position sizing. You'll see a lot of the times I ended up taking quite a few starters. A lot of times when I do take starter positions, there'll be losses. That's why my win rate was underneath 40%, is because I would take a lot of smaller starter positions and I would end up cutting those if they didn't work out. And if I had a solid position, as you can see right here, I was able to capture in a lot of money. So I took a lot of starter positions. I took a lot of small losses, but when my setup came and I knew I had an edge in the markets, that's when I would put on size. And you can see most of my money was made when I had a decent amount of position size, right? Whereas compared to my starters, I almost lost on all the starters that I had. But as long as you have very small losses with those starter positions and you nail your solid A+ setups, right? That's when you'll end up making a lot of money. And that's where you can see my P&L chart graph as a whole. That's where I had very minimal drawdown, is because I was taking a lot of small losses on those starter positions and I would nail the actual position on nice size for those solid wins. So one thing to note is that everything was tracked. So I had all my statistics tracked out. So I was able to review these and see what I can improve on. And that's how I was able to make this type of money and how I was able to make money consistently throughout my trading career. It was because of the journaling and the tracking and everything that I did. If I didn't have these statistics, I wouldn't know when my best opportunities came. I wouldn't know when I trade the best. I wouldn't know what my risk reward ratio is. I wouldn't know what my trade win percentage is. I wouldn't know what instrument I like trading. If I didn't have these statistics tracked, I would have never known this. So that's why they're so important to track and to journal and to look over your statistics statistics every single day to see what you can improve on as a trader. I see a lot of people ask me, how do you improve as a trader? It's all done outside of the market hours. When you're not trading, you're going to be journaling. You're going to be tracking your statistics. You're going to be refining your system. You're going to be finding ways to improve your edge slightly over a shorter period amount of time. If you have a 1% increase on your edge, that is huge over an exponential amount of trades, over 100, over 1,000 trades. If you have a 1% edge in the markets, that is going to be a huge determining factor of your overall success in the markets. So I want to talk about my strategy, and this is basically the full bare bones of the strategy and what I was looking for. It's the price action around key levels. If price broke above this key level, I was going to see the reaction around this key area. If price was going to continue towards the upside, right, I'll be looking for a buy position off this level, looking for a reward towards the upside, or I'll be looking for a potential break below this level, and I'll be looking for a potential short for a push towards the downside. So this is the most basic bare bones of how I was able to make this money. I was looking for key flips on support and resistance levels, right? If we were breaking above a level and holding, I was going to take a long position towards the upside. And if we broke below a key level and we end up retesting towards the downside, I was going to be looking for a position with minimal risk with a high risk to reward ratio. That's how I was able to make that type of money. You'll see a lot of times, right? I had a 40% win rate, so I wasn't right a lot of times, but when I was right, I would make a lot of money. So now let's go on to some of the live examples that I took in real time to achieve these results. Okay, so on my first example here, and the main thing I always talk about is risk. It's not about how much money you make. As you can see right here, I made $6,200 on this trade, but it's not about how much I made, it's how much I risked. As you can see in this case, I was only risking about $900 to be able to make this type of money. I only risked $900, ended up being a 7 risk reward ratio. I actually took a couple losses before this, but this was the trade that I ended up nailing, and this was the perfect trade that I needed to make a decent amount of money for the day. So let's go into the live session and see exactly what I was seeing on the charts. So as you can see, we're on my live example here, and we recently just ended up breaking underneath its key level. So the levels I have marked out, as you can see, is basically your opening candle print and your opening candle print low. And what happened was I actually just ended up trying to use this as a retest. I quickly ended up getting stopped out. So now I realize that price is back underneath your opening candle print. As you can see on the higher time frames as well, right? We have potential room towards the downside. I have a key level right here, which is your 874. And now we got underneath your 874. We got underneath your opening candle print high. So I'll be using this level as basically a retest for continuations lower with my risk just to break above that level. As you can see, I also just entered in my position. I have 11 contracts here, basically right at this level with around 11.2 average on the contracts. Now let's play out the tape and see exactly what happened. So you can see right now the position is starting to head my way. We had that very nice rejection off of our key level, which is our flip. We're now underneath our opening candle print as well. So I'm looking for essentially continuations to 855, which is where my contract strike price is. And I'm looking for continuations below as well. So you can see right there, Tesla is melting towards the downside. I'm scaling along the ways. My key target really is your previous day low, but as you can see, I'm getting paid as the contracts are moving in my favor. I'm basically just scaling as it's heading into my favor. So you can see right there, that basically was almost my full profit target right there, right down towards your previous day low for a super solid win. And you can see my risk in this case was just a break below, and my target was all the way down towards your previous day low for a super solid win. Very minimal risk, as I mentioned. It was only risking $900 on this trade. Ended up making over $6,000 for around a 7 risk reward ratio. Absolutely beautiful trade towards the downside. And this is exactly what I look for. I look for a very minimal risk for a large amount. So that's why I had a 40% win rate and I was a very profitable trader. So now let's go on to the next example that I have for us today. As you can see, we're on my next trade here. And as I always mention, it's not about how much I made, it's about how much I risked. So in this case, I was risking around $700, end up having a 5 risk reward ratio. And let me go over exactly what I was seeing in the markets. Something to also keep in mind as well, whenever you have a higher risk reward ratio, your win rate is going to decrease. So in my case, as I mentioned, I had around a 40% win rate, but my risk reward ratio was so high. That's why I was able to make that much amount of money in that short period amount of time. So now let's go on to the live session that I have for this day. You can see the setup that we're looking at coming into this day is we're looking for the retest off of your opening candle print. So the same principles still apply. I'm still using the exact same strategy to this day. In this case, my entry model was the 84% rule. I just ended up getting stopped out. Now we're looking for that reclaim of your key level, your hold on the 5 minute of your opening candle print high. And we're looking for basically that retest and that 84% rule for basically continuation towards upside, right? My target was all the way back towards high of day, as you can see on the right hand side. And my risk was a very small amount, which was just a break below this key level. As you can see right here, my risk amount was very minimal. And let's see how this trade played out. You can see I just bought in around 8 contracts with an average of around 1483. As you can see, this exact setup that I mentioned, I'm looking for this kind of wedge break on the 5 minute with the hold of your opening candle print for basically that continuations towards high of day and above. You can see I'm scaling some contracts there, and it's so funny seeing the tape if when you look back on it, how you evolve as a trader. I was so happy that price pushed towards the upside, but now when I take a trade and I win, right, I don't really feel anything. If I win or lose, it doesn't matter too much, but looking back on the tape, I was so happy that price ended up pushing towards the upside. You can see right here, we have that clear setup I was talking about, that opening range candle on that 5 minute retest, right? Nice wedge break as well. We're looking for the hold of it. Entry model 84% rule, right? Very minimal risk for a very nice kind of push towards the upside. Very solid risk reward ratio, as I always talk about. And really the exact same setup. If you guys watch my videos now, I'm trading the exact same way. I've been trading the exact same way for the past 3-4 years now. Exact same strategy, exact same setups, and they're still working to this day. And it's so cool to see, right? The markets have not changed. It's the exact same setups, and we look for the exact same things. And these things repeat over and over again every single day. You just have to look into the markets. Oh my gato. Absolutely beautiful trade, as you can see right there. So funny seeing my reaction looking back on the tape, but beautiful trade off of that 5 minute opening range, looking for high day and continuation above, which is your 946. Ended up scaling majority of my position, as you can see, was scaling out of my contracts for a very, very solid win on the day. So now let's go on to the final example that I have for us today. The final example I have for us today is on Tesla. Once again, you'll see every single trade that I took was on Tesla. Only traded one ticker with one strategy. That's how I was able to grow my small account. And as I always mention, right, it's not about how much I made, it's about how much I risked. In this case, I was risking around $900 for a 3.52 risk to reward ratio, right? The setup was a very solid setup. As you'll see right here, is basically a classic break and retest for a nice push towards the upside. Ah, yeah, there is an edge. Let's see if it holds this. So you can see right here what I'm looking at is the opening range break and retest. I've hammered this strategy so many times over. It's the exact same strategy and it still works to this day. I've been trading this strategy for a few years now. And as you can see right here, I'm looking for that break above your opening range candle high. And I'm looking for that retest of this level for continuations back towards the upside. So as you can see right here, risk is 10. So you can see I just entered in my position. I got a little bit of a later entry that I would like to, but I was waiting for confirmation. Now I'm looking for that push towards the upside with a risk just a break below that opening range candle, right? Same thesis still applies, same setups to this day, and I'm looking for that push towards the upside with the relative strength in Tesla compared to the QQQ.
Risk is $700.
As you can see right there, I just mentioned the risk. I was only risking $700 on this trade.
I am bullish. Oh my gosh, I'm bullish.
So you can see we just broke above high of day. We're having nice continuation so far off of that opening candle range on that 5 minute that I always talk about.
I'm not selling. This is so bullish. Target's 14. Oh my gosh. I wanna run it high. Let's see the take speed up. Let's see this volume perk. I love this. I love this. Let's see a close strong. 5 seconds. 2 contracts right there. Just in case, but I think it's gone.
So you can see right there, basically close half my position, but beautiful trade off of your 5 minute opening range. As I mentioned always, right? The exact same setups happen over and over. I'm looking for reaction around key levels. I'm going to be breaking down my exact trading playbook from the intraday fundamentals to the bigger picture time frame to the technical analysis all the way down to the type of order flow. Before I dive into this video, it is very crucial for me to validate my claims. As you can see right here, I have my statistics pulled up year to date for this strategy. As you can see, I've taken 19 trades so far this year. 17 out of the 19 have been winners with an 89.47% win rate, making me over $104,000 in profits year to date. Every trade has been documented with proof and all been done live in front of hundreds of students every single day. So in today's video, I'm going to be showing you guys the strategy along with the real trades that I took in real time. So let's get right into the video. Developing a playbook is going to be one of your best assets to succeed in trading. The playbook I'm going to be sharing with you guys today, I've been developing and refining for the past 3 years. The reason why this strategy has such a high win rate with incredible results is because of the strict criteria that I look for when trading this strategy. Before I get into this, I want to mention that the results that you see are not common. They're based off of my personal trading results over the past few years. I've been developing this and refining it to my personal liking. I'm going to be showing you guys how to develop your own playbook so you guys can have your own entry exit criteria, what to look for on the higher time frames, how you guys can mold it to your liking and trading personality, and that's what exactly I'm going to show you guys in this video. Before I get started, I want to talk about what is a playbook and why is it so important. A trading playbook is essentially compiling a comprehensive document outlining your trading strategy, including setup conditions, entry and exit criteria, risk management rules, and trade management guidelines. The best analogy that I always reference when talking about the playbook is the football analogy. Whenever you have a professional sports team like the NFL, what we have is offense and defense. You have the offensive side of the ball and you have the defensive side of the ball. For example, let's talk about the offensive side of the ball. The main objective for the offense is to score touchdowns. If we're looking to score touchdowns, what do we have to do? We have to run certain plays to get into the end zone. We're trying to get into the end zone as efficiently as possible. What we have is we have head coaches, we have offensive coordinators, we have people that are tracking statistics, and what they do when they're not playing, they're looking at these statistics, they're looking at the tape, they're finding the best ways to optimize their potential to score in the most efficient way as possible. And that's the exact same thing as in trading. Whenever you're trading, we're going to be looking at the entry criteria, the setups, what type of market cycles are we in, the type of risk management, the trade management guidelines. How are we going to develop our playbook? We're going to be developing a playbook by compiling statistics. Over a long period of time, we're going to have statistics, we're going to have a playbook outline, and we're going to find out which best setup is going to be used in certain market conditions. So organizing this playbook in a clear and concise format, making it easy to reference and follow during live trading sessions. And that's what I'm going to show you guys, how to develop a playbook. Every successful trader talks about having a playbook and understanding that not all setups are equal. Not every single break and retest is equal. There are plenty of different types of break and retest. There's around 10 to 15 different setups. Not all setups are equal. Not every single break and retest is equal. That's where you have to develop your playbook and understand what type of trades that you're looking for on a day-to-day basis. So with that being said, let's go on to the criteria that we're going to be looking for to develop our playbook. As you can see right here, I'm on this slide, and there's essentially 4 main things that we're going to be looking for when it comes to developing our playbook. Number 1, being the bigger picture, what is happening and developing on the higher time frames. We're going to first start off on the weekly and daily time frame. What are we going to be looking for? Number 2, intraday fundamentals. Do we have a major shift in the fundamentals of the asset that we're trading? Number 3, what is going on with the technical analysis? What type of setup that do we have forming intraday? And then number 4, type of order flow / volume. Do we have some sort of relative strength? Do we have some sort of relative weakness, divergence? What type of volume is coming into the markets? So these are some of the questions that you just have to ask yourself when setting up a trading playbook. The higher time frames, are we in an uptrend? Are we consistently making higher highs, higher lows? Are we in a downtrend? Are we making lower highs, lower lows? Or are we consolidating on the higher time frames? Intraday fundamentals. Do we have any sort of news event that's happening? Do we have CPI, FOMC, PPI? Do we have earnings? Do we have a pre-anticipatory earnings run? Do we have a post-earnings run? What is shifting in the overall fundamentals? Is something happening? Is there some sort of news report that's coming out? Is there some sort of information that's fundamentally changing the company? Technical analysis. What type of trade management are we applying? What are our entries like? What are our exits like? What type of setup that are we going to be looking to apply intraday to try and capture those higher time frame trends? Type of order flow. Do we have relative strength and weakness? Is the name showing some sort of strength compared, relatively speaking, to the NASDAQ? Is the market weak compared to the SPY? Or do we have some sort of divergence in the market? If we're not correlated, do we have divergence? And why are we diverging away? So these are just some of the things that we have to ask ourselves, and it's very important if we're going to be developing a trading playbook. So let's go into one of the examples that I have for us today. So we're on Nvidia's weekly higher time frames, and we have to ask ourselves, are we bullish? As you can see, we're clearly making higher lows towards the upside. We're very much bullish on the weekly time frame. Next chart, we go on to the daily time frame. What's happening on the daily time frame? We're forming this big wedge pattern. As you can see right here, we're very much bullish on Nvidia. The weekly's bullish, the daily's bullish. We're consolidating above our flip zone, which is our 891 level. So we can expect continuation towards the upside if we have a breakout. So what's next? We have what's called our intraday fundamentals. This is any potential news. Do we have earnings or major news catalysts that are potentially coming up? As you can see right here, what we had was a pre-earnings run-up. So pre-earnings on Nvidia was very much bullish. The higher time frame was bullish. Everyone was bullish coming into earnings. So what we had was called a pre-anticipatory run-up towards the upside. Next, what we have is our technical analysis. So coming into market open, what type of setups do we have? We have the opening drive play. We have the gap and go. We have the dip and rip, 5-minute break and retest, 1-minute break and retest. When you have so many different setups in combination with one another, this is what's called multiple confluences. So as you can see in this case, our key level was our 922 level. You can see price ended up holding this level coming into market open. We end up tapping this level very nicely. Buyers are stepping in off this key break and retest level. We also have an opening play as well, a gap and go. And you can see we have the 5 and 1-minute break and retest, and you can see that's where our entry level was after buyers stepped in off this 922 level. Our higher time frame objectives was key levels above, and that's where we have that very nice push towards the upside due to all the setups and confluences that I mentioned. Next is order flow. Do we have any sort of relative strength or weakness? As you can see in this case, we have our Qs pulled up right beside Nvidia. And you can see clearly we have our opening candle low marked out, and our opening candle low is all the way down here on Nvidia. You can clearly see that we're a lot more bullish on Nvidia compared to the Qs. You can see the Qs start pushing down here, whereas Nvidia, we have that hold of essentially your 922 level, and that's where we start pushing towards the upside. You can see as soon as the Qs reclaimed our key level, which is your opening candle print, we also have that push back towards the upside, and that's where we had Nvidia launch towards the upside. So we're going to be looking for some sort of key relative strength or weakness. So with this being said, let's go on to a more recent example on a trade that I took last week. As you can see, we're on my second example right here, and this was actually a more recent example. It was on Amazon August the 2nd. So it was last week on Friday. Absolutely beautiful trade towards the downside. As you can see, I ended up making $7,000 on this trade, but what matters is not how much much I made, it's how much I risked. As you can see in this trade, I was only risking $1,000 on the contracts and ended up making over 6.2 R. So this is a 1 to 6.2 risk to reward ratio. Absolutely insane trade. You can see only put in $5,000 and then making over $7,000 on this trade for a 131% return within 8 minutes. The rest of my remaining contracts I ended up getting stopped out. So it's a little bit longer than 8 minutes, but 90% of my position I took off within 8 minutes of this trade working out. So let's go into exactly what I was looking at and how I was developing this playbook coming into market open. So you can see the first thing I was recognizing on the higher time frames was that we recently were just at previous all-time highs on Amazon. This was a high all the way back from 2021. You can see we end up getting above this level, we end up rejecting it. So we end up rejecting this previous all-time highs level, essentially sweeping out this liquidity all the way towards 200. You can see now as well, we have what's called a gap down. So we have a huge gap down in the markets. This is actually due to earnings. And now we have room all the way down towards this gap fill, which was this earnings gap up all the way back in February. So the higher time frames just rejected off the previous all-time highs level. So now we're going to be looking for shorts coming into the day. Intraday fundamentals, you can see here as well, we just had earnings. So this is a post earnings play. You can see Amazon right here tumbles 11% in the pre-market as profit revenue outlook starts to disappoint. So we have bad news, higher time frame is bearish as well. So now we're going to be going on to the next part of the playbook. The next part of the playbook is your technical analysis. So coming into market open, what type of plays do we have towards the downside? We have the gap and go on the higher time frames. We also have that gap fill, which is all the way back from that February gap that was actually a gap up. So we have that potential gap fill towards the downside. We also have an opening play that we can look for, and we have essentially your pre-market low break towards the downside. So you can see right here, we had your pre-market low drawn out, which is your 165 level. So you can see right here, price is flirting around this pre-market low. We're already bearish on the higher time frames as well. I'm going to be showing you guys that we're relatively weak, and that's where we look to get in off this higher low. And then we can see we have that flush underneath your 165.3 level all the way down to your higher time frame objectives, which end up being a super solid trade. You can see on the next slide as well, what we had was relative weakness. The order flow was bearish. As you can see, we had that pop on the Qs. We end up popping back towards your pre-market high. We can see in this case, Amazon was staying heavy. You can see the discrepancy between these two names within the first 10 minutes. Amazon was at low of day, the Qs were at high of day, and that's where you have that relative weakness in play. And then you can expect the Qs, as it starts to reverse, Amazon have a big push towards the downside, and that's exactly what happened. So with this being said, let's go into the live trading that I have for us today. One thing I want to make very clear is that I take all these trades live. A lot of traders will talk about this in hindsight, but every single trade that I talk about was done in real time in front of hundreds of students. So if you guys would like to live trade with me every single day, the link is in the description below. So with that being said, let's get on to the live trading session. So as you can see right here, I'm on my live trading session for the day of August the 2nd. This is the live session for the Amazon trade that I just talked about. And now I want to walk you guys through exactly how I was able to capture this move in real time. The main watch I want to keep an eye out on today, this morning, is Amazon. We have an earnings gap towards the downside. We have this other gap, right, due to earnings all the way back from February. So if it can get inside this gap, we could see a nice push towards 159. So that's going to be my main watch coming into today. What I want to see is essentially an IV flush. I want to see a pop it open where the contracts, they get IV crushed, and then we can look for a push towards the downside on Amazon. So as you can see right there, I end up just talking about Amazon. It was my main watch coming into the day due to the higher time frames, due to the bearish earnings as well. What I wanted to see was an IV crush on the contracts where we can get the contracts for cheap, and then we can look for that opening play towards the downside. Now I'm going to speed up my tape here until we get to my entry. So Q's rejected off your 553, which is your 830 high, right? On the higher time frames, we're still bearish on the Q's. It's just kind of inside this range currently. I'm still interested on Amazon. We'll see the reaction we have around this key level for a push towards the downside. That's really the only ticker I'll be looking to kind of short. Okay, I bought some Amazon 165 puts here. I like this kind of rejection off of this Qs, and if Amazon can get underneath, if it can close underneath low of day, it can have a clear shot and flushed all the way down towards really 159. I really want to see the relative weakness. I still am bearish on the Qs on the higher time frames, so I kind of want to see uh, really the Qs start kind of gravitating back lower, and then I want to see Amazon head towards the downside as well. So you can see right there, I ended up entering Amazon puts, the 165 puts towards the downside. I mentioned that this is relatively weak compared to the Qs. You can see Qs end up rejecting off of your 830 high, which is your pre-market high. I wanted to see more continuation towards the downside. You can see right here, essentially the entry model was looking for a break below your opening candle print, which was your very key level. I was looking for continuation. If it could get underneath this key area with that relative weakness, right, we have a lot of room towards the downside, towards that daily gap. So that's what I was looking for on Amazon. And now we'll see how the tape plays out. Amazon, this candle is most likely, yeah, it's closing underneath low of day as well. So we should have more continuation towards the downside. You can take some off, just do the 0 DTs, but it really has clear room all the way down towards that daily gap on the higher time frame. So as long as the Qs kind of stalls or kind of gravitates towards the downside, Amazon should be the leader, with it being the gap fill all the way down towards 161, 161.72, and then 159.68. So you can see I just mentioned we had that strong candle closure underneath low of day on Amazon. I'm expecting a potential bigger move towards the downside. There's really nothing stopping Amazon from heading lower with the relative weakness in the Qs and the higher time frame daily gap as well. I mentioned my main objective was really that 161.70, which is that daily gap on the higher time frames. Yeah, I took a lot off right there as it was coming back down towards that 160.70 level. I'm going to hold my final trailers potentially all the way down towards 159, but right there, that was an absolutely insane trade on Amazon, right down towards that 160 as it gave up. So you can see right there, I just mentioned that I took most off of my position right there at that 161.70 as we're approaching that key level. The contracts at this point, they're up over 200% within 8 minutes. Absolutely monster trade towards the downside. And you can see the spillage as soon as we got underneath that key level, which is your 165, we had that big push towards the downside. You can see not a single green candle, and we end up continuing lower as well. And that's what happens when you trade those higher time frame textbook setups along with the relative weakness as well. Let's see, how about majority now? So I'll just let traders run. Yeah, so that was essentially earnings play, right? If you're stuck on the lower time frames, it would have been very hard to capture those based off the higher time frames with the news factor, with that gap on the higher time frames, weak earnings. Essentially, like kind of like an earnings play. You'll see a lot of these. It was like Nvidia way back, and now you can see it flushing. Now it hasn't even had a green candle. That's what you like to see when you're trading 0 DTs. It doesn't have a single green candle on that push after it broke 165. It has clear shots down towards that 159 that I talked about, that daily gap on the higher time frames. I mentioned it can move pretty quickly if it can flush underneath that 165, and now you can see exactly where it gravitated towards, right at that key level. Right, look at this daily gap that I mentioned. If it gets underneath here, now this looks like a classic break and retest at this level all the way down towards here. Right there, that was basically my full trade for Amazon. I ended up leaving 10%, got stopped out the rest of my contracts, but absolutely beautiful trade towards the downside. The whole community was able to capture that trade towards the downside as well. Absolutely beautiful trade, 200% in 8 minutes. And that's one of those trades that we can look back on, and that's within our playbook. And it was a textbook setup towards the downside. Becoming successful in trading is simple, but not easy. Everyone tries to rush the process without putting in the necessary work in order to become a successful trader. Everyone comes into trading with the mindset of getting rich quick, not realizing that day trading is in fact getting rich slow. So in today's video, I'm going to share with you the 5 steps I've learned to help you become a profitable and successful trader. Step 1, find a profitable strategy. There's so many different strategies out there nowadays. You have support and resistance, supply and demand, smart money concepts, price action. The list goes on and on. Don't listen to anyone saying that one strategy is better than another. You have to figure out what strategy works best for you. And by doing that, you have to test out every single strategy. And to do that, you can go onto YouTube. There's so much information out there nowadays where you can learn about all different types of strategies. Finding a strategy that fits your personality is one of the most important aspects of trading. If you have personality traits of an impatient person, you might want to look to trade intraday and more scalping, compared to a person that has a 9-to-5 job where they can only look at the charts every once in a while, where they would like to prefer swing trading, right? Which is holding a position for multiple days at a time. You have to find out what works best for you and that is up to you. No one can tell you which strategy is going to fit your personality. That is what you have to figure out on your own. So this brings me to step 2. Once you find a profitable strategy, what you're going to want to do is backtest your strategy. By backtesting your strategy is you're going to go back in time and you're going to find out if your strategy has an edge. An edge is one of the most important aspects of trading, finding out that if you have a positive expectancy. A positive expectancy means you're expecting positive results over a series of trades. 10, 20, 100, 1,000 trades, right? You need to be able to backtest your setups in order to gain the confidence and experience you need in order to become a successful and profitable trader. There's so many different backtesting softwares out there, the main one being TradingView, which is implemented in your chart platform. Backtesting is one of the most important aspects, especially backtesting in journaling. You want to look at past actions, price action, to determine future price action movements. So in doing so, you understand the probabilities of your setup. So when your setup does come, you can execute it and have the confidence you need in order to become successful. This brings me to step 3, which is find a mentor. When I first started trading, I did not have a mentor. I thought that this was an individual game, so I would always be by myself. And if you guys have been trading for a while, you understand that trading is a lonely game. You have no one but yourself, and that at times can be very difficult. So I encourage you guys this year to go out and find a community, right? This can be a paid community that you guys can learn and connect with other like-minded individuals. One of my turning points in my career was when I found one of my mentors, and he helped me take my trading to the next level. I understood that he was where I wanted to be in trading, and he was grateful enough that he could help me guide me in the right direction. He was a lot more profitable and successful trader than I was, but I was able to learn from his experience, and that skyrocketed my growth. So finding a mentor or a community where you can come together and trade is very important. In trading, you're trading against a bunch of market makers, institutions, people with a large sum of money. So if you're an individual in this game, you already are at a lot of disadvantages. So finding a mentor is very important, and I advise you to do so in 2024. And that brings me to my 4th point, and that is fixing your psychology, right? Psychology is one of the most important aspects of trading. Once you do all the 3 steps, you'll realize that trading is 90% psychology and 10% technical. So with this being said, once you have mastered your system and your rules, you want to focus in on your psychology. To become a master in trading, you have to first be able to master yourself. Of course, that is easier said than done, but the longer you trade, the more you will figure out about yourself. Trading reveals so many different personality traits. The way you act in trading is correlated to the way you act in real life. If you're an impatient driver, you're most likely an impatient trader, always rushing to get in that next trade, that next setup. You have to be able to understand your personality traits. The way to level up your psychology is by journaling, reading a bunch of books, watching a bunch of seminars, and just talking to other traders. A lot of other traders have been through the exact same experience that you have gone through, so you can connect with them on a personal level. This will allow you to refine your psychology, make it so you can know when to pick up on certain things. One thing that really helped me with my psychology is understanding that emotions are a part of the game, right? A lot of people are out here saying that you have to be emotionless as possible. That is true to an extent, but you have to understand that we are all human and that we're going to have emotions. So instead of trying to be emotionless as possible, you have to use what your emotions are telling you and use that to your advantage. One book that I highly recommend for you guys to read is Trading in the Zone and The Mental Game of Trading. These 2 books helped me a lot in my trading journey. It has helped me refine my psychology to what it is today. You're always going to be working on your psychology. It's a never-ending thing. You're always going to be improving on yourself consistently. The markets always change. You change as a person. You're going to be changing as a trader. You have to make sure that you understand this and that you can evolve as a trader over time. I've been trading for almost 5 years, and every single year I evolve as a trader. I learn new
things every single day. You always have to be a student of the markets. And that brings me to my final point, which is number 5. Consistency is key. Consistency is one of the most important aspects of trading. To become a successful trader, you have to constantly keep practicing and sharpening your edge. If you don't consistently sharpen your edge is eventually going to become dull. If you don't constantly do the necessary things in order to become a profitable trader, you're going to eventually lose your edge in the market. And once you lose your edge in the markets, you're going to slowly start to lose money. So we always want to make sure that we have a positive edge, meaning we have a positive expectancy. And that just comes from consistently showing up every single day to the markets, no matter what. And even if you're not a profitable trader, consistency is what's going to get you to become a profitable trader. You go to the gym knowing that you're not going to become fit, but if you show up for every single day for a year, for 2 years, you're eventually going to become fit and you're going to have that dream body of yours. That's the same thing in trading. You're not going to become successful in a few months. It could take a year. It could take a few years. It all depends how consistent and how you're driven towards this game. Just know that it is going to be a very hard process. Understand that the journey is what matters. Being able to have those ups and downs, you'll look back on it and be very thankful that you got past those periods.
Hopefully you guys enjoyed that 3-hour long course. It took me a while to put this all together. All I ask is for you guys to continue supporting me and I'll continue to make these videos. So with that being said, hopefully you guys enjoyed that. I'd appreciate it if you guys drop me a like and sub, and let's make 2025 the best year ever.